GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. Gizzy. GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. GizzyCredit. Don't get scammed. What you need is just a change of plans. And time is money, you know, get that cash. Whatever it comes, just get it fast. GizzyCredit. GizzyCredit.
Duh. Hello. How you doing, my people? Your boy GizzyCredit here. Thank you so much. Please like and subscribe. I see a lot of you logging on through Facebook and here on YouTube. There's a boogie monster. The boogie monster right now. Well, it's been going on for a long time. And there's word that people are saying that, oh, inflation is going to get you and all that stuff. We're going to get into it today. Thank you so much for logging on. I go by GizzyCredit. We talk about economics, finance, real estate, credit, and of course, we do credit repair the last 10 years. You're looking for a credit repair quote. Right here, my email. Email me how you get a credit repair quote, or DM me, and I'll send you my how to start credit repair info. Shout out to everyone out there. Got my cafecito ready right here. So let me know where you guys are from. Put it in the comment box. I'll see it, and I'm gonna get to your your questions in a few. I believe I forgot to tag the video, so this is video all in a rush. I'm so sorry, but hey, we here, right? Anyways, let's get it started. Let's call up John. Okay. Hey.
Hello.
What's going on, John?
What's going on?
Good. How's the Rona treating you over there in Florida?
Well, I didn't have the Rona, so if you're talking about the whole area, I don't know. It doesn't seem like you get out here and you don't really see anybody.
Florida people are just like famous people because of the way that they are and they think.
Say that again?
Florida people are famous people because of the way that they are and they think about the Rona.
Honestly, man, I'm telling you, it's just another day down here. You really don't see a whole lot of difference in behaviors down here. I mean, you're seeing some pretty basic behaviors and nothing really over and above that. So you're not really seeing any kind of adjustment as far as behavior is concerned. And I keep saying that you're just not. I mean, it is what it is. So yes. I mean, people are still kind of going about their business. People are. I think a lot of people have started to kind of block out the news. I guess I don't know. You're just not seeing a lot of behaviors change, and these numbers continue to go higher and higher and higher. So I don't know.
We're leveling off here in Jersey, in New York State. I mean, Anthony Fauci was talking about how we should model after New York City. And I'm like, how are you going to model after New York City just because we shut down? But then again, so many deaths. I don't know where he's getting that thinking from. But What
Yeah,
he's
what thinking
supposedly
about the fact that they should model after New York?
correct. New York State.
Yeah, I mean, I think basically, but you got to understand. I mean, so many people in New York were infected. So, I mean, who knows? And look, there's so much stuff about this virus that nobody has any idea about. Still, I mean, it's crazy. So, I just think, I think he's more saying surrounding the fact that everybody just took it. Everybody in the whole northeastern quadrant of the entire country took it real serious when it came,
Yes.
And down here, it just was, you didn't take it as serious. And, this is where we stand right now. So, and nobody's, I got to be honest, it doesn't seem like anybody's taking it any more serious now. So I'm not sure that if the media's objective is, solely to try and scare, I'm not sure you're scaring a lot of people down here. If the objective is to make people aware, I think everybody that lives down here is aware of what's going on, and the ones that are, smart and exercising caution are doing so, and the ones that couldn't care less are behaving accordingly. It's crazy.
I know. Every time I hear news of Florida, it's always kind of gossipy too. Like, depending on which network you're watching, it could be good, it could be bad. So I really, with the way that New York City and that whole East Coast was a month ago to what you guys are experiencing now, it's like you must be going crazy, right? Because you were like, all right, cool. John lives in Florida, and John travels to Philadelphia for the summers, and he lives in the summers in Philadelphia, and then he travels back in the winter to Florida. So he's thinking, yeah, we're gonna go to Philadelphia and see family, fun times with the family. Next thing you know, the riots happen, and you're like, damn, I gotta get out of here. And next thing you know, you go back down to Florida, and then you gotta go through whatever you guys are going through right now. It's like, it's crazy.
Yeah, but I gotta honestly, man, it's there's still up in Philly. There's still a lot of stuff not open. For obvious reasons. It's about the same level of opening. Florida might be have a little more access. So I'm not really mad we came back down here. And honestly, it's not impeding on anything like that. I hear what you're saying, though. It's true. It's been crazy because, it's like they always say, you can't outrun a hurricane, right? People hear a hurricane coming and they just start running, right? And they try to get out of the state, and then the hurricane turns and it gets them there, right? A lot of people always go to Georgia, to get out of South Florida when there's a hurricane coming, and it always ends up in Georgia. So the people go from Florida up to Georgia, and then they try and move from there. You can't ever outrun it. It's the same idea. Like this stuff, you can't, with the virus, it is what it is. You just got to find a spot to be able to just sit tight and get comfortable. And down here, it's better just because of the fact that it's more spread out down here. In Philly, obviously, it's a lot more dense. It's, it's like the sixth biggest city in the country. So it gives a little more space here, obviously, and the ability to, spread out more, not have to be around people as much, and kind of pick and choose and stuff like that. So I'm glad we're back. And honestly, I don't really watch a lot of the new stuff just because I just think it's trash anyway. I mean, it's tough to watch on a sustained basis, and a lot of the stuff they say is just ridiculous. So, not saying that the case count and stuff going up isn't true. It probably is, but I mean, how many times can you say that in an hour? Oof. I mean, it's almost like they're trying to brand it on your brain. It's enough. You see it in the papers, you see it in there. It's like you get enough of it that you can only take so much after a period of time.
Yeah, and I don't know how things are doing over there as far as price wise. If things are getting more expensive, if they shut down, like California shut down. How's life? Are you going inside of the supermarket with a mask on, or are you following protocols?
It's mandatory. You got to go in the house, you can't go in anywhere without a mask on. So I mean, at least that level of precaution, at least in stores. I'm not sure about restaurants, because when we first got back down here, we went out to eat. We didn't have to wear masks, but I think it's different now. I don't know. I haven't gone out since. So, listen, it is where price is going up. Real estate prices are going, because a lot of people are moving down here. It's just such an anomaly. It's crazy to me. I talked about this last week. It's crazy to me, the fact that you have people that are moving into the storm. It just goes to show you just have people that they're just not interested. There's just such a disparity and just such a disconnect in people's perspective on what this virus actually is, what it represents.
Yes.
The degree to which it and that it impacts people. It's just there's just so with social media and the level of influence that has on a regular basis now, and just all the conspiracy theories that pump out of that on a daily basis. So many people just have so many different perspectives, and some people just don't even take it serious. So like I said before, I just found two other clients of mine. We're down in Miami. I found out Thursday. They're like, yeah, we're probably gonna move down here.
Wow.
They're from up north. They're up from Philly, and that's all right.
Glenn, what country you from, Glenn?
Sounds great. I didn't even want to get
Glenn
into
on Facebook.
So I said, all right.
What country you from?
I'm at like 2 clients a week now, going back about 5-6 weeks now. 2 clients a week that are moving down to Florida. Yeah, it's crazy.
I saw someone on Facebook.
All clients, actually, two of them were business people that like associates of mine. One of them was a VP of the bank. The other one was a business associate going back a while. So, I mean, it's 90% of my clients. Some of them are just other business professionals, that I have relationships with.
Saratoga Springs. How nice is that area?
I don't know. I have no idea. I mean, I think if I'm guessing correctly, I think it's
on the West Coast.
Yeah, it's on the west, but it's inland west, right? So it's not like water west; it's like inland west. So okay. I haven't been there. I'm pretty sure it's over there because when I was driving back, one time I went to Fort Myers. When we were coming back, I saw the exit, but I'm just not entirely familiar with it. Just because sometimes in the off the water, you would have if you don't live over there, you'd have no reason to kind of go inward. So when you do visit out there, you wouldn't see it. But that's all I know.
That's true.
About that. It's definitely on the west side, though.
What's hilarious is the Cubans that I see videos on Facebook of the Cubans in Miami, Florida, not wanting to wear a mask. They think that it's they're taking your rights and all that, and it's just so funny that the way Cubans talk. I don't know if you have any Cuban friends down there, but it's always good to have a Cuban. They're hilarious, just like Dominicans and you Puerto Ricans. Over here, it's all over the place. You find a Cuban or Puerto Rican or Dominican friend, and they seem to be the funniest of them. But aside from that, Jay, let's get to the topic of today's video that I talked to you about, and how everyone's talking about the new boogeyman that may be out there, and that boogeyman is called inflation. And I'm getting a lot of realtors, real estate investors talking about how to hedge, what to invest in during inflation, because there's so much money being printed, and a lot of people may not know how inflation works. So we want to make this podcast just to kind of educate you guys on how this inflation could affect you, what it is, and kind of get a little background from John to see if you guys got any questions during the process of him explaining it. We'll get back to you. Now, I see a lot of questions are coming through with Marcus Smith. I'm going to get to your question as soon as we finish the topic discussion. Definitely stay logged on. And go ahead, John. What's going on with inflation?
Right. So you are hearing it get thrown around a lot right now, and obviously it's being thrown around right now, the term inflation, because of the fact that the Fed's printing a lot of money. There's a lot of money coming into the system through the stimulus, and just a lot of the Fed-related stuff. And given the fact that we're basically just printing money right now, it's not backed by gold to the degree that it ever needed to be at one point in time. We're basically obviously weakening the dollar when you do that, right? So the more dollars that you print unsubstantiated, you're effectively weakening the dollar. That effectively means that it's going to cost more dollars to buy any product. Those products could be anything. They could be milk, it could be bread, it could be lumber, it could be, now granted, lumber, milk, and such, and wheat, these are all commodities, right? But as a rule of thumb, typically speaking, when you're printing more money, you're weakening that dollar, and obviously those prices go up as a result, right? So, but the thing is that the one thing traditionally with that in mind, right, is that along with wheat and milk and lumber and gasoline, right, typically inflation sees everywhere. So you'll see house prices go up, you'll see equity prices go up, etc. They normally run in conjunction. And the reason why you're hearing realtors talk about it is because they're probably looking for any reason to try and convince people to try and buy right now, because most people aren't, and most people still haven't put their houses on the market yet to increase the inventory. But The greatest hedge to inflation that exists is buying real estate, right? Because it's just like anything else. It's a material item that you purchase. It just happens to be an asset. So as inflation goes up, the value of your property theoretically is going to go up, right?
Yes.
So when the cost of milk goes up, the same $300,000 property goes up. Milk goes up 10%. I mean, obviously it's not completely parallel and synonymous, but if the price of milk goes up 10%, in theory, you figure that's maybe 30 cents. You figure if your house goes up 10% on a $400,000 house, that's 40 grand. That's a big number, right? But you're offsetting it, right? You may not realize it in your pocket right away, but that's why. That's the general premise behind why they're trying to say that. But to suggest that inflation is something that's sitting on the doorstep, and as a result, you need to be aware of it and you need to position yourself properly. But the problem with the argument, which is where I think more of the information comes in, because I assume people have a natural understanding of how the general idea of inflation works, is that right now they're trying to suggest that this is a good time to buy, right?
Correct.
They're trying to buy so that you can stay out in front of inflation.
Yes.
But here's the issue, and they're using the basis, a lot of people are using the basis of Fed printing as a reason to do that, right? So here's the problem, though. The problem is the Fed's been printing money since 2008. Since the market collapsed in 2007, it's been on and off through the stimulus package that came out in 2007, 2008. It was effectively called the bailout.
Yes.
Then there was quantitative easing that went on after that, which they didn't start selling out of those bonds until 2016, 2017. They actually didn't finish selling those bonds right up until recently that they had accumulated then. Now, they also started pumping money into the system at the end of last year, October, November. There was an overnight repo problem where the Fed, the New York Fed, through the main Fed, pumped $81 billion into the market. All these things are money printing. All of these things are inflationary pressures. We haven't had a drip of inflation to where it becomes a worrisome issue since before the collapse in 2007. If we did, you would have seen the Fed be forced to have to push up interest rates to offset it, because that's the one mandate that one of the large mandates that they have is when inflation starts to run away, you have to raise rates in an effort to offset inflation, right?
Yes.
Because of the response that assets will naturally move in response to. We haven't had any inflation. We've been nothing but a manufactured market, at least the majority of manufactured market since 2007, 2008, that's been propped up through money printing over and over and over again. So this new set of money, you're effectively saying, okay, the other 90% that's been pumped into the market over the last 10 years meant nothing. This new 20% is going to now cause this incredible amount of inflation, which it's unrealistic. It's not reasonable, not to mention the fact that right now, all the supply and demand things are out of flux. We've talked about in the past, right, about people that typically want to sell the house are not selling right now, and they don't know if they're going to need to sell because they don't know if their job's going to be around in a couple months. So you may see a float of much more inventory, which the reason why you're seeing house prices go up is because it's a small amount of inventory and still a trace amount of demand right now. So you're seeing that show itself just in inconsistencies that we're getting back in. We're getting reacclimated with the market, right?
Yes.
So the concern that now you need to buy because you need to hedge it, you need to offset all this impending inflation, I don't think that's realistic, nor do I think it's something anybody should really be concerned about if you really do the math and you step back and you look at how things have gone over the last 12 years. Because like I said before, I mean, yes, the fact that we have a stimulus package that's been some insane amount of money and there's another one coming, it's a lot of money, right? But if you really do the math and you look relative to the last bailout and then the continued amount of money, there was $81 billion pumped into the repo market, overnight repo market at the end of last year, and they did it quietly, right? Most people, unless you understood finance and you were tracking the way that you should, most people that sit in their living rooms and don't follow the way they probably should weren't even aware of that. They were having a problem with overnight assets at the Fed. Typically what happens is if you're a commercial bank or a hedge fund, you pledge assets to borrow money. The problem is the liquidity wasn't there from the hedge fund, so the banks had to the Fed had to literally come in and prop that up to the tune of $81 billion. That's a big number. That's a big leak that you have in the system. And if you consider $81 billion, it's not a small amount of money, right? So but these kinds of injections from the Fed would all be inflationary pressures, but they do nothing. They do nothing because the reality of the situation is that when you're running, let's just say a 20 or 30% unemployment rate, or even right now they claim we're at like, I don't know, 11, which I don't, I think the real number is closer to 20, but let's just go along with 11, and you're running 11, and then you say to yourself that 9 or 8 of those previous 10 buyers are only still available now, and you're losing 2 of them, right? So effectively what happens is the demand drops, so it offsets itself. So the fact that they're pumping money in and dropping interest rates, that the demand goes down, it evens itself out. I was explaining to you earlier today on the phone that Japan did the exact same thing. Japan is the first country, and I've talked about this the last two podcasts we did, to tell people to go back and look at, if you think 0% interest rates and Fed pumping endless amounts of money into the system is something new. It's not. Japan's the first one that did it, and Japan did it in response to, there was a point in time in the late 80s when Japan and the United States were like the United States and China, right? Neck and neck. The economies were battling each other back and forth. They were our largest
competitor
at that time.
Okay.
And what ultimately ended up happening is they developed such an insane amount of credit over that period of time that they and their population curve, that they weren't able to service it. So, we obviously, we just did a census in our country. I don't know how that plays out, and we were not going to find out for a little while. Yeah. But in Japan, other than values dropping, was the fact that they didn't continue to grow as a society. So they weren't able to service it. So what they had to do, and they were the originators of this, they just started printing money.
Oof.
They dropped their rates down to 0, and they just started printing endless money. They haven't stopped. They've run a 256% debt to GDP, which is the highest in any developed country, and they're still pumping. They haven't had a trace of inflation in 25 years.
Okay, Jay.
They've continued to pump money into the system. So just to give you an idea that when you pump in times of problem, the idea of inflation just does not present itself the way it would in a different circumstance.
Okay, so not to cut you off and still keep that train of thought and still keep that fresh in your mind to keep educating us. But what's the difference between Japan printing money and, let's say, Venezuela, who also printed money? And they could be more, they have oil. So their inflation is off the roof. Why is it? And is it because of political reasons? One is a capitalist society.
Wait, hold on. Why is Venezuela running away? Like, why are they running away inflationary wise?
Yeah, why is their inflation all the way up and everything?
Well, because they have no economy. Their economy is Venezuela's bonds yield like 40%. They have nothing to balance it against. They don't have any GDP in Venezuela.
What?
Yeah, sure. They got oil. They own about 1/10 of it. They've rented a lot of their oil fields have been either seized or levied against by the Russians and by the Chinese.
Oof.
A lot of the assets that they had, Venezuela's in a really bad spot, right? And a lot of their oil is subsidized through the state too. So it's not like a free market. It's a totally different dynamic. We lever and we build our country based on our GDP. Same with China. Same with every developed nation, right?
Yes.
That's effectively how you levy it, and you levy it based on a lot of other economic factors. How much, each individual makes, the average wage, where your growth is, etc. All these other variables that help to continue to spur growth that offset some of that stuff, right? When you're Venezuela, you're a one-trick pony. You got oil, and a lot of that oil you've had to basically pledge over the course of the last however long period of time in an effort to continue to stay afloat. So, when you start getting into smaller countries like that, right, relative to the big guys, no, they're gonna feel it's the equivalent. It's the equivalent from a big company, a Target, down to comparing that against a much smaller, like, mom and pop shop that has 7 or 8 locations, right? And how are they going to sustain relative to economic ebbs and flows? Who's going to get hit more? It's an ideal, analogy or comparison right now. Look at all the small companies that are getting rocked right now as a result. Some of the bigger companies are getting, that are getting bailout money. Same with the smaller ones are, and how people are responding. It's just not, when you're a smaller country, you don't have the same economies of scale as you would if you're the United States or Japan or one of the G7, right?
Yeah, but how about I'm talking about, like, I just finished saying Venezuela, and it's oil rich. But how about these Saudi countries, like what is that famous Saudi country that build a whole bunch of tall buildings? I forget.
Abu Dhabi?
Abu Dhabi, the other one that's famous that people go and travel to.
Qatar?
No, the other one. The
I don't know.
Fast and the
But
Furious, they went over there and made a movie. I forget.
Brazil?
No, they went to a Saudi Arabian country because somebody told me where they went on
I don't
Facebook
watch
or
that movie.
YouTube.
But listen, it's all.
But
you
they
gotta
did they sorry to cut you off. They got a whole bunch of new you know, you said that there's no economy. The United Emirates,
in Venezuela, I say there's no economy.
there's no economy, but this other oil-rich countries, they gotta, you know, have tourism to come in. Dubai, there you go. Glenn Byers just told me Dubai.
Right. Dubai's obviously an oil-rich country, and there's an element of tourism there, sure. But I mean, it's on a much smaller scale. You got to understand, Russia's an oil-rich country. They're in the G7, G8. You know, they're one of the big eight. They feel it the same way, but they're smaller. They're smaller relative, so they do have economic ebbs and flows. I mean, look in the history, the financial history of Russia. Smaller the country gets, the more the blow hurts, right?
Yes.
So I mean, I don't know the size of Abu Dhabi or Dubai or any of them because they're not even countries that. I mean, they're small countries, right? Relative to the big guys, they don't even come on the conversation. Abu Dhabi is. I mean, you're talking about Saudi Arabia, which is the big one that's got the oil, right? I mean, but if you think about it, they pull the oil out of the ground. It's not like the United States here. There's not, they own that land, right? So their cost to get that out of the ground is significantly different than the United States. So they have a lot more margin in order to resell that oil and still make money. So their cash crop is oil, right? They have it in their front yard. They have it in their backyard. Saudi Arabia is, I mean, they're totally different. I mean, because they can still make money even in a down market. If our producers in the middle of our country, it costs them $45, $48 to get it out of the ground. Right? It doesn't cost that over in Saudi Arabia. It might cost half that. Right? It might cost a quarter of that to get it out. So even if the oil goes down to $35 a barrel, they're still making money, right?
Okay.
So I mean, they're different circumstances that don't apply evenly. It's not an even. I mean, the only way you can really evenly apply it is when you're dealing with like nations of similar sizes, which is why you have designations like the G8, right, which meets couple times a year to discuss like global things because they're all relatively on the same scale, right? And they're so large that any policy decisions within that country can impact another country, right? So they try not to do that to each other because of how intermingled they are, right? And how a decision by the United States could impact greatly any of the other countries, right? Or subsequently China, which is another one of those countries. So I just think, when you're trying to compare the two, I don't see how there's a comparison. So
you're trying to say that things have stood the same since '08 when they started printing money to what they are now? That things are
no. I'm saying that they haven't ever stopped printing money since '08. There has not been a stop of printing money. I mean, you guys, this isn't an opinion. This is a fact. Go back and look at it. I mean, just look up the Fed injecting money into the system. I mean, the quantitative easing, I don't know, you guys probably have heard the term, but I don't know if you guys are familiar with the idea of it. There was a QE1, there was a QE2. Okay, so they went through quantitative easing 1 to resurge the economy at like 2010. Then they had to do it again in order to prop the economy up after that. Like I said, it went well into 15, 16, and then they started selling off in 16. That means they literally kept buying bonds and injecting money into our economy from 2008, 2009, whenever that initial stimulus passed, all the way up until 17 or 18, which now they're just pumping money back in again. Not to mention the $80 billion they popped in before. They had difficulty even exiting their position. So what ultimately ends up happening is, for instance, when they did the quantitative easing, they were buying bonds in an effort to prop up the economy. Well, their objective is not to keep these bonds on their balance sheet. They do it as a hedge, similar to what they're doing right now. So the idea is that they have to sell them at some point. Like any investor, or lack of a better term, they have to replenish their funds, right? They got to put money back in their pocket, or they got to be able to exit when they think the economy can handle it. They had trouble getting out because there's no buyers as big as the Fed. It took them a long time to unwind a lot of their purchases, and they didn't even end up completing it. So they still have bonds on their balance sheet from probably 2011, 2012, which is not what they meant to do, because now they got to keep pumping, right?
Yes.
So I mean, their balance sheet is so bloated right now. Meaning the Fed, with purchases they've had to do over the last 12 years in order to keep our economy turning. This is why whenever anybody has the argument about the chance to raise rates, no way you raise rates. You raise rates on what? Like the most that we got up to at one point was, I think, maybe 1%, 1.25%, I believe is how high they got. I may be off, maybe 0.25%, right? But you're talking about that's the highest they were able to raise interest rates, right?
Yes.
In 1985, I think interest rates were 16%.
It's crazy, and people were still buying homes at that time.
They were, but also think CDs were yielding 16%. So you go, and savings accounts were yielding 16%, 18%. You put your money in a savings account with no risk. You're making it. You put $1 million and they made $180,000 doing nothing. Think about that, because they work synonymously. Now we're in a generation where we're not going to see those rates probably ever again, right? Because of all the easing and because of all the money the Fed has to pump in and because of all the reasons to keep it down in order to just keep a crush on the market. But just think there was a time when that happened. You know what I mean? Like right now, a savings account yields like, I don't know, 1/10 of a basis point. It's a joke. A CD is like, you're talking 1.5% if you can find a gem, and they'll lock you up for 5 years. You're not going to see that stuff anymore, man. Not for a long time.
Question for you, Jay. Curtis asked a question: if Japan populations grow, can they fix it? But my question to you is: did Japan ever let people immigrate there? Because I guess that's why.
I don't know about the immigration part, but to answer Curtis, I haven't heard of them being that kind of a country, so I don't know. As far as
that's what I'm saying. I mean, usually or normally when you let people immigrate to your country, they reproduce. They want to stay there if the economy's good. I mean, that's why I came to this country. I mean, I'm from El Salvador. I came here in 1989. Well, my mom came here first, but then land of opportunity, United States of America. Well, I didn't have kids until recently, so, but a lot of immigrants come to a country and they reproduce, they contribute to their economy, whether you agree with immigration or you don't. I mean, some people take advantage of, the welfare system and all that, but normally an immigrant goes to a country and they run a different life and they contribute to the economy. I'm thinking, something has to do with that.
Yeah, I'm not sure. Look, I don't know what the ratios are, right? As far as in a given society or in a given country that's that size, what percentage is applied to immigrants. I know that in their particular case, the reason they ran into problems the most in the early stages was because their population was not growing, right? Therefore, all those other areas that would naturally spur demand, and that you would naturally assume would help to grow demand, because as a family has 3 kids, those kids get older, right? And then they have kids and so on and so forth. That wasn't there. So it forced them to have to start injecting money, and they've constantly been injecting money ever since. To answer Curtis's question, if they start raising a population now, they are running a 256% debt to GDP level. It is the highest of, I think, any country known. So they'd have to do a lot more at this point, because they've been pumping money into their economy for so long. You're talking 25 years, right? We're theoretically, if you're telling the truth, our Fed's been pumping it in for probably 12, right?
Yes.
They're probably double that, right? So, I mean, you get into that kind of a situation and it would be very difficult at this point, in my opinion. But again, the key is that, if you look at it from the perspective of them, and that inflation isn't becoming a problem, just like it's not going to become a problem in this country, and it hasn't been a problem in this country for the last 8 or 9 years, then if you're I don't know what they call the Fed governor in Japan.
Antonio, I'm going to get to your question
right?
as soon as we finish up the subject matter, okay?
You're saying as if you've done your job, right? You're keeping the economy propped up, you're keeping inflation low, which means that obviously people don't need to make more money. You don't have to pressure wages for the companies in order for people to have to make more money to buy these products to qualify more. You're keeping inflation in check, but you're keeping the economy propped up, and then you just kick the can down a little longer, right?
Yeah.
Because that's all these guys do. Nobody's owning it definitively, right? Jay Powell will be out whether it's next or soon, he'll be gone, and then somebody else is going to be stuck holding this bag, right? And none of them want to be the one that let the bag blow up, right? So they all just figure out ways to continue to push it down the line without really taking any real measures to try and fix it. I mean, this would have been a great opportunity, economically speaking. It's funny because you see all these retailers that are going bankrupt, right? Almost on a daily basis. Literally on a daily basis, you're seeing another one, either Chapter 11, 13, whatever the case may be. You're seeing them file left and right. And the fact of the matter is, why couldn't they do that with the airlines? Well, I mean, there's an operational bankruptcy that they offer. Like, you don't need to bail out a company. They have set up scenarios where you can literally have an operating company that can file for bankruptcy. They can still operate during the period while they're working out with their creditors. You say to yourself, like, why wasn't this done more tactfully and just much more, like, there's some businesses that just should not continue to keep getting bailed out. I mean, how many times have we bailed out the airlines? I mean, if it's a non-working business model, can you imagine, like on Main Street, some guy whose business fails over and over and over again going into a bank and being like, listen, I need more money. Like, fuck no, I'm not going to give you any more money. You know what I mean? Like, you're a nice guy, but your business isn't making it. I'm not going to give you any more money. Certainly not going to prop your business up so that ultimately you don't pay me later. I'm not going to give you grants so that you can stay in business only to have to come back to us in 10 years. It's so illogical.
But how about these places, though? Let's say people in your, in Philadelphia who got rioted, right? And it's like, I need money. I mean, of course, they're going to give the person money, right? But you got to have insurance for that. That's something different, correct?
The only one lending money right now is the SBA to mom and pop shops. They're the only people that are spreading money. They're peppering they're peppering small business with money right now.
But even with that, you need to have a specific credit score in order to get some type of funding from them.
It's 575, but that's really flexible,
yeah,
right?
That's flexible.
I mean, that's extremely flexible. If you were to go in a normal market and you walk into Chase Bank and try and get a $150,000 loan, which seems like their sweet spot, which they like to lend around, if you're making a certain amount of money, you'd have to have spotless credit, and your financials would need to be exceptional. Yes. They're taking a stated application. As long as you got a 575 and your business, makes money on paper, they're giving you $150,000 or somewhere thereabouts. I mean, it's there's no bank that would take on that kind of risk. They're talking about the PP, and again, I'm talking about the disaster loans right now. The PPP loans are through banks, but it's a different circumstance. It's a lot smaller amounts for relative to the business itself. Where the risk is being exposed for the SBAs is in disaster loans, which the banks aren't underwriting, and they're being provided directly from the SBA, and you don't have to go through a bank. Terms are insane. They're like 30-year payback terms, which is great. And the point I'm trying to make, though, is that if you're a business that wasn't good 10 years ago, meaning it wasn't making money 10 years ago, and it wasn't making money 15 years ago, and it was barely making money 5 years ago when everybody else was making money hand over fist, why the fuck would you give it money now? Again, like large amounts of money, right? Like, why is that logical? And it's not. It's not logical. It's just there's no logic behind it. So you just call it what it is, And it's a shame, though, because it's money like this, right? Like, when you think about things where that money could be going, in repairing the situation, or in going back and being specific about just aiding in lessening the amount that the Fed has to pump into the system, right?
Yes.
Because I don't know why we become so lazy, politically speaking, around everything just falls back on the Fed. Congress does just enough, right? They throw out a big number, they make everybody happy, they acquiesce, and then the Fed's got to carry the bags. Problem is, we're paying for all of it, right?
Yes.
We're effectively paying for all of it. So, I mean, in essence, it falls on our shoulders at the end of the day anyway, because we're going to be the ones that are going to have to reconcile the books when all these guys are out of office, right? And that money's still floating out there. The difference is with the Fed, that can hold off a little longer. The other stimulus money, that goes straight to the deficit, is going to have to get paid back. So, I mean, it's a
so our taxes are going to go up.
Absolutely, yeah, it's inevitable. I mean, that's the only way that's how deficits get paid down. I mean, if you're government, you don't have a multitude of other ways to generate money. That's how you generate money.
So who's in charge of that? Is the president in charge of that?
Taxation?
Yeah.
Yeah, it'll start in like the Appropriations Committee in the House, right?
Okay.
It'll get worked through, and the president ultimately will have to, the Treasury obviously works alongside it. All the necessary financial, bodies that make decisions in our country work in conjunction with each other to approve it. But I mean, if you think a big tax bill, I mean, if you look, everybody, I mean, Biden's already come out. If he wins, he's already said expect tax hikes next year.
Yeah.
Even Trump's guys have come out and said, listen, in very tongue-in-cheek, because they know now's not the time to be talking about it, but they said there's going to come a time we're going to have to pay this back. And anybody that understands what they're talking about means they're going to have to tax. He dropped taxes, that's great, but I mean, you can't float that kind of a deficit over that period of time and not start to address it. It's just not possible because it impacts future spending on other things, right? If you don't start paying it down, it impacts the ability to pay for other stuff, like the soldiers and the military and all the other stuff that we contribute to on a regular and annual on a basis. That is absolute money that needs to get obviously properly distributed. So
someone just said the kids are screwed.
Yeah, I mean, look, something's. Look, I've been saying this forever, but I don't know if it's the case. I mean, you say to yourself, something's got to give, right? But if you back out and you say to yourself, well, as long as the Fed keeps pumping money into the system, and as long as corporate America keeps doing what they do, you can keep kicking the can, because that's what we've been doing now. I mean, we were, in my opinion. I mean, look, I was born in '80, right? So, in my opinion, I think that we were probably as close to a free market until, I'd say we were probably a large degree of a completely free market, right? Until about 2005, 2006, 2007. And what I mean by that is, like, now there's just so much manufacturing going on in the background, right? With all the algos and all the money being pumped in. And it's a lot less of a free market, at least from the stock market, than it was a long time ago. That's why a long time ago in the 80s, you would see days when the market was down. I mean, Black Monday the market was down 20%.
Oof.
Imagine that today. The Dow closed today, I think, like 28, 29, something like that, 20% down. That would be a 5,000-6,000 point down day. Now, that's more consistent with human nature. Something hits, people start flipping out, right? I'm not saying that's what you want. That's a worst-case scenario. I'm just saying that's much more embedded in human emotion. Now you've kind of devoided humans from the situation. You have a propping up by a Federal Reserve. You have a lot of machines that are doing a lot of the trading on a regular basis. So you don't see the same – I mean, you saw it when the virus hit, because you saw a lot of unloading from funds that had accumulated and were booking profits from when they bought back in 2008, 2009, 2010, right? Because they thought the top was in. But generally speaking, you're not seeing the same amount of, even on volatile days, that you would see in the past. And I just think there's a lot of manufacturing that goes on to keep the lights on, right? And I think it's a lot more than people even realize. I think what we find out relative to, like, the overnight repo I was referencing, $81 billion, that's a really big deal. Like when the Fed has to pump in $81 billion into overnight exchanges, assets for collateral, right? I mean, it's a very standard scenario that goes on in very standard basic banking. To think that they were short for literally like 2 weeks, and the Fed had to come in and keep pumping liquidity in to make sure that market kept floating when it should have kept floating on its own naturally in a normal market. When you see stuff like that, you say to yourself, man, this boat has holes and they're trying to plug it as it happens, But that all extracts the free market element of it, right? It really does. When they
say the house of cards are going to fall at some near point, you ever heard of that term?
Yeah, they use the house of cards. They use the house of cards back in 07, 08 because everything's so intermingled. But I mean, it's now it's different though. It's different now than it was then, because everybody's kind of cognizant of what's going on now. I mean, back in 07, 08, it was different then because there was a lot of people that were blind to the idea, right? Or didn't want to understand, because in all fairness, as a society, nobody understood credit default swaps unless you were on Wall Street.
Yes,
nobody understood a lot of these secured mortgage packaging that got resold, and then the depth, and then how they, all these different things people didn't understand. So when the market was going up, it was like, yeah, that sounds great. Nobody knows they're out buying credit default swaps to cover the backside. Nobody knows any of this stuff, right? So people were none the wiser. Now you have a group of people with the advent of and the much more application of people learning on their own how things work and through online brokers and things like that. People understanding what's going on, and they have a much better understanding of economics. I think the one thing that came out of 07, 08 is that people realized that they need to get a little more conscious and aware of what's going on, right? Rather than just trusting somebody blindly with their retirement money. So I think there's been a movement in that direction. Obviously, not to the extent that would be in their best interest, but I mean, there's definitely a much more cognizant awareness than there was back then. But at the same time, I think that right now everybody sees the writings on the wall. I mean, you had something like a coronavirus in there, and things start to just spiral. And I think I think they're talking about putting out another stimulus next month, right? Right when in an effort to try and keep it propped up, right? That's the idea, right? Because they know August is effectively, once that unemployment, that additional 600 comes out of the market, and you start having to face, that kind of a cash situation that you're taking out of the market in that period of time, how that reverberates all the way around, right?
Yes.
So they're trying desperately to figure out some way to feather that out. So that's just not an extraction of that. It's more of a feathering out that they're going to try and include in the stimulus in an effort to keep it propped up. But how many more stimulus bills is it going to be? There's not going to be that many more. I mean, the minute there's a coronavirus, you're not going to a vaccine. These stimulus packages are going to start. I mean, this one's probably going to be the smallest of all of them, I assume.
Do you think it's just being propped up because of election year as well?
Absolutely, 150%. I think there's a lot going on with the Fed right now that's helping to keep the market propped up, and I think it's going into the election without a doubt. I had zero doubt in my mind, and you're seeing a lot of funny things happen, and I think as a result, I mean, when in the world, I mean, look, there's things going on in the market right now that make absolutely no sense in the stock market. I mean, you see, I understand we priced into the market the fact that the coronavirus came the first time. I understand that, and that made logical sense. We took a huge dive as a economy and it rallied, right?
Yes.
But now you're talking about case counts that were worse than they were then. I mean, you didn't budget that in. Nobody budgeted that into the fall, and the market's running like it's like there isn't even a coronavirus. I mean, we don't have.
Correct.
We're not sitting in situations where there's even an adjustment in the market when the case count. I mean, it was like 80,000 cases that were reported over the weekend, right?
Oof.
In one day, there was 80,000 cases reported, right?
It's crazy.
So you say to yourself, 80,000 cases, that should garner some kind of a response. Any of this should have garnered some type of response. And I think, you're just continuing to see it plug higher. So when you see stuff like that, it's just, I don't know, things just smell a little funny. It leaves you to think that we're inevitably going to run up until, in my opinion, because you're seeing the VIX start to break down. Like, and anybody that listens to us knows that I talk about the VIX a lot. The VIX is just a measure.
And the VIX is not VIX Vapor Rub.
No, it's not like VIX Vapor Rub. It's the volatility index, and it measures the they call it the fear index. So when it goes up, obviously people are more scared. You see a lot more selling. When you see it go down, obviously there's at least perceived in the index, there's less fear and more certainty is presenting itself. I don't know how that jives. So I don't know how to rationalize that. So because it's not. I mean, there's no certainty. I mean, you're talking about a situation where larger states are shutting down again and rolling back, and none of it makes sense. So when things don't make sense, there's normally more at play, and I think that's probably what's going on right now.
So when they say what's the best hedge if inflation is gonna hit, they say
if you believe that inflation is going to hit, then assets are your best hedge. And by assets, I don't mean a vehicle. You're talking about stocks. You're talking about property. I mean, they're any kind of property, really. I mean, not like a mobile home or something, because that's more like a vehicle. I'm talking about like true assets where you own the land, and because they're going to offset it. They're naturally going to offset whatever. But I want to repeat. Everybody make their own decision based on how we're breaking this down for you. But historically, this is not going to be an inflationary situation. Historically, going back 30 years, when people start going back with Japan, like I talked about earlier, the idea that we're going to get into some extremely inflated area of inflation, I just don't see that happening. Nor do I see the Fed allowing that to happen. Okay, because if that does happen, they're going to be put in a really bad position, right? Think about that. I mean, they're literally the backstop of the market. If they turn around tomorrow and say, "Look, we're pulling back the money we're putting into this," we think we were worried about inflation, and as a result, the market will drop exponentially the minute they find that buying is starting to pull back. So there's just so many factors as to why that's not going to happen over and above what I've already explained. But if somebody wants to entertain it, the way that you hedge, the easy low-hanging fruit hedge is obviously just to buy real estate and equity, right? I mean, that's the way you hedge it, because they appreciate greatly. You get a ton of tax write-offs, at least on the real estate side. I mean, there's so many different variables there. That's why real estate is such a good investment. But it would be the way you would hedge it if you truly believe it. Now, this is something we talked about, you and I, today. Is I said, do I think now is the time with the limited amount of inventory and people overpaying for properties?
I was just about to ask you that.
What's that?
I was just about to ask you that too.
Yeah, no, of course I don't think now. I've been consistent, and I'm going to stay consistent. I don't think now is the right time. Why would you overpay to treat it as a hedge? That even if inflation does go up, you're still just going to be able to get back to zero if you're fortunate, right? So it's not that kind of a movement, right? Over a sustained period of time, if inflation peaks like very quickly and short, over maybe a quarter, you're not going to see asset prices move that much, right? It needs to be over a sustained period of time in order to be able to really utilize that hedge that you're referencing. It's not like an overnight scenario, right? Because real estate prices don't move overnight. They take time, because settlements take time, right? It takes time to get a property under contract. It takes time to go through the mortgage process. It takes time to turn around and sell it again. So, I mean, with that, things move slower. And as a result, if you were thinking that we're going to go into a really inflationary environment, then that's what you would want to do. That would be the easy way to protect yourself, and to just make sure that you stay out in front of it.
But people also run to go buy silver and gold too. You think that's good too?
Yeah, I mean, silver more so than gold. Gold is out of its mind right now as far as price. Everybody's run there, and obviously, I mean, that's more of a flight to safety move, right? I mean, because the idea behind the flight to safety with gold and silver is that if the economy completely explodes tomorrow, and you owe gold and silver, then you have a means of currency that everybody respects, right?
Okay.
And there's a value to that. Like, let's just say tomorrow the dollar completely there is no dollar, right? No Bitcoin, no dollar. We go back to some menial society. How did people pay each other going back in the day? In the 1700s and 1800s, they paid each other with gold. That was the means of currency before dollars came into effect. So that's the idea behind the flight to safety always with gold, because they're actual tangible goods, right? And they hold value. Gold is that doesn't matter what kind of economy we're in, gold will hold value. So that's why you see that rush to that kind of safety. But I think price-wise, because gold, silver's at like, I don't know, $18 an ounce. I think, gold's at like $1,700 an ounce. I mean, it's insane right now. So, because everybody's rushing to that for protection, right?
Yes.
Which is weird, because the market's going up, and it just goes to show the disconnect that I was trying to explain earlier. Because typically speaking, when the market dumps, you see people run to gold, right? Or they do it as a hedge, right?
Yep.
You wouldn't see gold at an all-time high, and then the market's approaching all-time highs at the same time. You would never see that, right? Because there would be no reason to see that, right? Why would markets be going to all-time highs and you still be out buying gold? You would want to be rushing into assets at that point, right? Appreciating assets, more clear assets, not protectionary assets covering your downside. So there's just so many disparities that typically would not have been present that are just exponentially present right now that, they're hard to explain logically.
As a someone just said, when the stimulus stops 6 months, 6 months later, real estate will plunge because people won't be able to afford to stay in the property.
Yeah, well, we talked about that before.
How do you feel because I know you own apartment buildings and stuff, so how would you feel about that? I mean,
well, I've talked about how I feel about where prices are going to go for a long time. So, I mean, I have absolutely I feel very confident that if they don't get unemployment under control, that it's supply and demand. You can't. We're a consumer-driven economy. 65% of our economy is consumer-driven.
Oof.
I think it's great right now that the people that are unemployed, who can't qualify for a mortgage because they're unemployed, obviously, that they have the liquidity to help, go buy things at grocery stores and on Amazon, et cetera. And they're doing a good job of keeping Walmart and Target and Amazon propped up, right?
Yep.
But the reality is that from a broader perspective, when you look at it in January, when the market, obviously before we tanked, when everybody was kind of sitting in a comfortable place as far as where they thought the economy was at, you've now extracted 2 to 3 of those buyers out of the equation. So, think about that. You had 10 buyers in January because unemployment was effectively at 2%.
Yep.
Right? 2%. So that's almost 100% of the people in the workforce, right?
Yep.
So you're talking about, at that time, 100% of the people you could buy because you have documented wages, you have the ability to go and buy. Now you're sitting in a situation which I think is more realistic, which is around 20% unemployment, which is a real number once you really look at it. If you ever really want to do research on how they book the unemployment number that they hang their hat on, it's disturbing relative to the real number. But let's just say it's 20%. You're extracting 2 buyers out of that 10-buyer pool. So you're given the fact that we're a consumer-driven economy, and you say to yourself, okay, you had 10 buyers before, which sold, let's just say 10,000 houses that year. In order to get to 10,000 houses, that means those 8 buyers now, because you don't have 10 anymore, you have 8. That means those 8 buyers literally have to buy like a house and a half to get to that same number. You understand what I'm saying?
Yes.
So unless unemployment gets down, that's why you hear everybody talking about unemployment so passionately. And whatever you see on TV, you gotta actually comb through the numbers. But if you don't have the same, you run into that problem. It's just numbers game. So unless that unemployment rate goes back down to wherever it was, it's going to be very difficult to get the same level and amount of houses sold. If you have less demand, similar amount of supply, then that starts to force prices down. Now, if we start to build up inventory, right, because right now inventory is at trace amounts, as we talked about, you start to build up inventory and you have less buyers and you have less interest, then you start to see prices start to accelerate quicker. This is just pure economics. This isn't specific to this situation, right?
Yes.
But I'm sprinkling in examples of this situation. So, it's a situation where I think it's good to sit back and watch. You asked me what my opinion is. I've said from the very first podcast we did relating this coronavirus stuff, I said I think, you're probably looking at buying opportunities towards the end of this year into early next year, depending on how long it takes it to fall out. Now, they're propping it up right now. With if they do another round of stimulus, you're going to drag it out another couple months, right? But I still think you're talking about a situation where end of the year into next year, because that's when people are going to understand what their finances really are. Right now, you're kind of in like you're at the front door, like I always say, and they won't let us get past the front door because they're doing everything they can to keep it propped up going into the election, right? Because that would be the worst thing ever if they walk into the election or into the time of the election with a collapsing stock market, right?
Yes.
And a collapsing real estate market. In order to keep it on a level playing field, this is the only way it's going to happen, right? So, I am looking to buy. I'm always looking to buy. I'm not buying right now because I've already explained why that is. Just everywhere is so frothy, and the people that are out buying right now are, I can't rationalize it other than maybe they're being given bad information. But at the same time, I think there will be buying opportunities again going into next year. Maybe late this year, but I doubt it. Probably early next year. I'm leaning more towards just because how desperately they're trying to keep this propped up going into the elections.
Did you hear that, Captain Insano? He was the one that wrote, when would be a good time to buy a home next year or wait longer than that?
Well, listen, here's the thing. We'll know, right, what...
How does an investor like you say, what do you look at when it comes to...
Value.
Okay. To say that's a good deal right now.
At the areas that I invest in, I've been investing in for a long time, right?
Okay.
And you can normally recognize value based upon where the market was at. It's a really strong probability it's going to get back there at some point in time, right? Yes. Not immediately, but if you're a long-term investor and you're doing it for all other different reasons, there's a very real possibility you can just sit back, same way with the stock, and run with it. Now, if there's income coming in from the rental, obviously, that helps. If there's work that you can do, obviously, you're going to build equity into the property that way as well. But, I mean, look, I think once we start getting to the point of like a real economy again, not this kind of propped up, tapered socialist scenario we've been experiencing for the last 5 or 6 months.
Yes.
Then you'll start to see things that'll present themselves as cues when to buy, not to buy. I mean, you don't want to be buying when they're telling you on the news to buy. I can promise you that much. When they're telling you to buy, you better run in the other direction. And I'm pretty sure I've heard them tell people to buy over the last month. So when you start hearing the guy on the news telling you need to go out and buy a house, and it's a smart move to buy a house, you need to start second guessing your philosophy, because they're the last ones that you want to be taking investment advice from. So I would just say, though, that there are going to be opportunities, good, bad, or indifferent. And I just don't I say this every single pocket. I don't understand what the rush is. I really don't.
Well, John, when you see pictures, Saturday and Sunday on Facebook, and you see a broker open, or for sale house, and they show pictures of people lining up. I got 50 leads today of people trying to buy this house. Like, there's a whole bunch of people just out there. Are they just wanting to be out, or did they want to buy a home? You know what I'm saying?
No, here's what I correlated to, right? I don't know if you or anybody that's listening to this has ever run like a marathon, right? But there's always people that do their best to get out in the front when the race starts, right? They get out there, they sprint, they have absolutely no endurance whatsoever, but they're out there for like the first mile, right? And they're just busting their ass. They get to a mile and a half and they're keeled over, right? And you ask yourself, if you knew you weren't going to make it, it's a 12-mile, 13.5-mile run, why the fuck did you burn out on the first mile, right?
That's right.
And you're not ever going to get an answer to that question. It's just a mentality, right? It's a fucking moron mentality, excuse my language, but it's a mentality. It's a mentality that certain people, it's just a thing. Like, that's the latest and greatest. So they're going to run out and do it, right? Because that's what they need to do. They need to get out in front of the other guy next to them, right?
Yep.
Forget about them. I need to get out there. I need to get the house that I love. Knowing that the probabilities tell you that most human beings in this country, a large percentage of them, don't live in the house for more than 5 years, right? So then you say to yourself, these people are convincing themselves that they're going to live in those houses forever, right? And then next year happens, and they're like, you know what? I don't like this house anymore, and they want to sell. But then they turn around and they say, shit, I paid too much money for it. I can't sell it, right? And then they'll try and short sell it, and it'll be that whole disposal scenario. But the fact of the matter is that there's just no need. Interest rates are low. They're going to stay low. There is no inventory, which means you're basically slighting yourself by buying now, because there's going to be more houses available over the course of time, right?
Yep.
And there's a very real possibility you can get a nicer house for cheaper. But instead, you want to compete with the jerk-off next to you, and you want to go out and you want to overbid a house just in effect to say that you got the house now and that you overpaid for it. I love the people that are proud that they overpaid for a house. That's going to look real well when you go to try and sell it, right? If you're the average guy and you sell that house within 5 years, it's going to be really nice to know that you ever paid for it. Or if you run into a situation.
Oh, no, they're going to blame the realtor, that the realtor told them it was an investment.
Of course they're going to blame the realtor. They're going to blame anybody but themselves, right? It's going to be anybody but themselves' fault that they rushed out a week after they opened the economy in New Jersey and bought a house in North Jersey and overpaid 30% for it, right?
Correct. Hold on, Jay. John Montano is asking, how about refinancing? My neighbor is going to refinance his house this month. We actually had a podcast on that. This is the thumbnail of it. So go to my channel, go to the live section, and you'll see this right here. And it talks about what's the best to do right now. Refinance your homes or buy a house now. So we definitely, he asked about refinancing, Jay.
So, I mean, rates are low. I mean, they could go. I mean, look, if you go back to a couple months ago, we did a podcast on rates. We've done a couple of different mortgage-related ones and rate-related ones. And what I was telling to people back then, this was when rates were still floating around 3.5, right? Right after it, when the market first dropped and then it pulled back and started working its way up, rates started kind of gliding up, right? And then as the Fed injected itself more and as, other things started to present themselves, you started to see the work back down. Well, when it was about 330, I said, look, we're starting to get down near the bottom, right? Meaning, like, there's only so low you can make it to where it still becomes, because Fannie Mae and Freddie Mac buy a majority of these conventional mortgages, right? Whether, they're backstopping the FHAs, they're buying all the conventionals. So, I mean, you're sitting in a situation where it doesn't, if you're getting a 2.75, I know the rate right now floating is around 2.75 on a 30. They pay to, let's just say Chase originates the loan, right? Chase Bank. You take a mortgage out with Chase, you go conventional. Chase funds the loan, then Chase turns around, packages it up, and sells it to Fannie Mae. Well, Chase gets about 80 basis points off that to service it, roughly, give or take, right? 80 basis points is like 0.8. Okay, so if your rate is 2.75 and Chase is getting paid 80 basis points, then you're talking about a situation where net to Fannie and Freddie, without any other fees in the middle, they're only making about 1.9, 1.85 on each loan. I mean, you're starting to get dangerously close to not being able to even outpace inflation, right? So you say to yourself, then you're going to run into, they're not going to do it, right? Then you're going to have to start getting some kind of Fed stimulus in that regard, right? Because that's how our economy flows. That's how mortgages get floated around. You can't expect Fannie and Freddie, which are, I'm air quoting right now, I think they're considered public companies independent of the government, whether or not that they've taken government bailout, and they are probably government entities. But the fact of the matter is, it's not their job to lose money. You understand what I mean? So in any effort that you're getting so close right now, around 2.75, it's going to be difficult to push them lower. So these rates, to answer the original question, which was asked, do I think now's a good time? Yeah, I think now's a good time. I think if you're going to refi, not buy, but I think if you're going to refi, I mean, you could squeeze down a little more. But if you ask yourself, what's the difference between them 10 basis points on a $400,000 loan? You're talking $4. So, I mean, does it make sense to wait, or is it a vanity play that you want to say you got 2.69, right? I mean, it's really, because there's not going to be that much of a difference on a $400,000 loan from 2.85 now to 2.69. It's not going to be, when it correlates to the payment, it's not going to deviate that greatly. So, I think now is a good time, personally. And look, if somehow, some way I'm wrong, which I don't think I am, because I give you guys examples of where my mentality arrives from, right? Because it all backs into the numbers and the return when it comes to Wall Street stuff. If my numbers are wrong somehow and it gets down to 1.5, then obviously you can refinance again at that point. So there's nothing inhibiting you from doing it, but I don't see it getting much lower than, I've been saying this now for 6 months, and we're in the doldrums of the market. So I just don't think you're going to get much lower than where we're at right now, from a sustained perspective. So it would be a good time, in my opinion.
Be a good time to refinance. John has extensive knowledge in how mortgages work and how they get resold, so you kind of get an idea of how it works. Anything else that we should talk about when it comes to inflation before we get to the questions, Jay?
No, because I'm only talking about it because you told me that it's all over Facebook now, and it's annoying me, the misinformation that exists that just confuses people, right?
Correct.
I just don't. It's unfortunate because it's so difficult for a consumer to find a direct place to get real financial information, right? Unbiased, without any caveats or any. Obviously, if you're a realtor, you're pushing something because you're trying to sell property, right?
Correct.
For us, inflation has no bearing, at least on the stuff we do on the credit repair side, right? Obviously, I'm very versed in inflation because I have assets and I've been dealing in this capacity for a long time. But as far as wanting people to understand it so that they don't get hosed, much like the one we did on interest rates not that long ago when, everybody say rates are going to go up, you got to refinance. That was all over Facebook. So come on, the rates aren't going up. And it's like the quicker that we can try and address some of these things, and for the people that do listen, if we can help give them a better understanding so they can make their own decision. And look, if that decision is like, look, I think inflation is going to go up, so I'll buy a house, and that's how I'm going to hedge it. I'm going to be proper about it. If that's what they determine after hearing his stuff, that's fine. At least they were given the proper tools to be able to make that determination, right? Yes. And that's all that's all I think is important. When you see somebody just going a rant on Facebook or Instagram about inflation and not really understand how the origins of inflation or exactly how it works relative to the broader economy, or just really don't understand economics at all, and they use that as a bully pulpit to convince 50 other people who don't really understand it either, but that guy sounds like he knows what he's talking about, so I'm going to repeat it, right? and then it just turns into this groundswell. I'd really like to just stop that, or at least help people so they can understand the reality of it. You know, I can assure you that if the Fed really thought that inflation was going to run away by injecting all this money into it, I can assure you they wouldn't be doing it, because they would just have to reverse engineer what they were doing altogether. Because that's effectively how you offset inflation, is doing the opposite of what they're doing right now.
Okay. So any questions you guys have, please smash that like button, share button. That's the best way you guys can help us out. Smash that like button. Thank you very much for staying on, watching. Thank you so much for your questions. Any questions you have about credit related, finance, real estate, mortgages, economics, John is here. We answer all your questions. When we first started the live cast, we have Marcus Smith from Las Vegas, who said, Las Vegas, how bad would a voluntary repo affect my credit? He said, for a voluntary repo, 15,000 car worth 8,000. I was thinking to have the charge off and then settle the debt. And my interest rate is 17%. So right now, Jay, just on the people that we've helped that are paying 15%, you know, that's for to the life of the loan. Paying 15% interest rate is like an additional $13,000 that you're paying with a 15% interest rate on a loan that a person has. What do you think about that?
Well, I mean, it's obviously he was in a situation where he probably hopefully didn't get taken advantage of. Maybe that was all he get. Maybe, you know, at the time, I don't know. But I mean, if his situation is the car's worth 15, he owes 8. The car's
worth
what?
8.
And he owes 15. I'm sorry, I flipped him.
Correct.
And he owes 15. He's upside down 7. I mean, in all theory, you could get. There's ways that you can roll that into a new loan if his credit's good now. You know, I don't know if it is or isn't, but if his credit's good now, what he can effectively do is he can turn around and basically roll the negative equity into a new loan at a lower rate if the rate's right, 2-3%, which is prime right now on auto loans. Talking about a situation where you'll pay back that negative amortization, you know, quickly, right? Because the lower the interest rate, the more goes to principal. Even though they front load the interest, when you're borrowing at 2.25%, it's effectively free money, right? So even if there is a breakdown in that instance, the majority of your payment, even on the front side, is going to go to principal rather than interest. So you'll pay back that negative equity relatively quickly. Plus, your payment will be significantly lower, right?
Yes.
So I mean, I wouldn't, if there's not a problem now, I definitely wouldn't advise. You know, if he doesn't have anything else negative on his report, I wouldn't advise doing that. I just don't. There's ways around it. You know, like I was just saying, effectively what happens is you trade your car and you go into a dealer, you find the car that you want, and they take whatever. Let's just say on that car they're willing to give him 15, and he owes, like you said, 8. Or I'm sorry, they're willing to give him 8, and he owes 15. They take the 7 and they add it onto the new car loan, and that's how you work it out. So you effectively overpay for the new car, and then overpaying for the new car. You're able to get out of the existing one. You're able to do it at a good rate, which gets him in a much more sustainable position over the course of time.
But how about, he said, the first question, how bad will a voluntary repo affect my credit?
I mean, it's all subjective relative to the report itself. It's a thin file, and there's 5 accounts on it, and, you know, they're all relatively recent, and this is one of them, and he puts a repo on there, which is going to roll it, you know, 120 and then eventually charge off. It's going to have a pretty significant response to it. If it's a thick file, you're still going to get a ding, but it's all going to be relative to the size of the file. I mean, but look, right now, anything negative on anything is a problem. So just because of the economic situation that the banks are trying to hedge against, because they're not sure of the certainty and the uncertainty going forward, and how many, you know, once the stimulus money starts to subside, they don't know how many people are going to be able to pay their bills. I mean, if you looked at JP Morgan's, you know, they had their earnings last week, which I referenced on Monday's call. I mean, they set aside like 30-40% more than they had to for losses, you know, just to be prepared, because you know, there's a real concern about obviously the huge uncertainty, but people's ability to pay their debts when this stimulus stuff comes off.
Yes.
And the government stops propping it up. So to answer the question, there's no real exact way to give you a definitive number how much it's going to drop the score. It's obviously going to drop the score, and it's going to drop it relative to the overall report. But in any instance, it's going to be significant. I mean, I think in an ideal situation with a build-out file and it's the only thing that's on there, you'll probably get a 35-point dump. If it's a thin file and there's literally, like I explained earlier, 4 or 5 accounts and everything else is good, you can see a 65-point dump all day. Yes. So, I mean, and obviously if it's a situation where you walk away from it and don't nip it in the bud right away, meaning you give it back and then you figure out a way to settle it, it's going to languish because then it's going to go 30 days, then it's going to go 60 days, and then it's going to go 90 days, and each month it's going to get worse. You know, obviously it's going to hit a number where it's not going to get any worse, but you can continue to get the reporting on that side of things. So, I mean, that would be avoided. An easy way to avoid it is what I just described. If the objective is to get a new car anyway.
And Marcus, we actually had a podcast, a whole full podcast on how to remove a repossession, and we go into how you first get into that in that repossession, in that situation. You can't afford the car, you gotta let it go. You get a repo with the whole process. We have a whole podcast on that. That's the thumbnail for the podcast. If you want to check it out, just go on to my YouTube channel and look on the videos and live cast. And we went for about an hour and a half, close to 2 hours on this live cast. A lot of people had questions. So any question you have, definitely we could answer. You could get an answer there on the live cast. Okay, so. Okay, he was paying 17%. Marcus Smooth. What would you do? What would you do? Well, we'll explain to you what we would do. That was a question that came in. Any of you have
what would I do as far as what?
No, what I mean, we go into what we on the podcast that we had on the screen here. They see the how to remove repossession. We go into what would you do scenario. Glenn, Philippines, what will you do? Good evening, Gizzy and John. Unemployment rate. Oh, we have another question here. Gizzy, can you speak on a question by Antonio Hesse? Gizzy, can you speak on how to file a complaint with FTC once you have exhausted the administrative process for removing a collection for support since they don't have a copy of the signed contract?
But how does he know the rules? Well, so you're going to send it to the Federal Trade Commission?
Yeah, he says, can you speak on how to file a complaint with FTC once you have exhausted the administrative process for removing a collection for support since they don't have a copy of the signed contract?
I feel like this guy asked us a question before about this. I don't know. Maybe it was. Maybe it wasn't.
No. I never seen this question before.
So look, the Federal Trade Commission.
We've never gotten into contacting the Federal Trade Commission. Is that right?
I don't even. Look. I mean, there's so much shit going on online right now as far as alternative. I'm sorry, it's true though. It's just so much shit. It's like I got to dig through shit every day and fucking parse out like what is real and what's not. It gets exhausting.
Remember, you gotta bleach.
I'm not trashing the guy that asked the question. It's
correct.
A legitimate question. If you ran into a wall, that's fine. I'm just like, there's so much crap that's on.
Well, John, if the bleaching didn't work, now he has to contact the FTC.
Right. The gardening didn't either. So but the point I'm trying. Look, I haven't ever had to answer the question seriously. With all joking aside, it's a valid question, and
correct.
We're
not getting on you, Antonio.
I haven't ever heard of disputing with the FTC. The Consumer Financial Protection Bureau, I've seen people utilize that. That's not something that we have to do. That we don't. I mean, I just don't think all these extraordinary lengths are needed to go. And I also don't think you need to. I don't know how the assumption is that they don't have the debt, right? Like, I don't know where that is. Everybody comes from that assumption that they don't have the debt. I can tell you from experience that when you buy debts, it comes over effectively, depending on the amount of debts you buy, you effectively, let's just say you're buying a bunch of charge-offs. Say you buy 1,000 charge-offs, right? You basically, what they send you is they send you an Excel spreadsheet and a zip drive, okay? That has all the information of the clients, everything that comes over. Within a month, you get the full package on all the paperwork of the assignments. Okay? So it's not like, I mean, I don't know what kind of collection this is. I don't know how you arrived at that conclusion. But in most cases, when people don't think they have the debt or copies of it, they do. Or they have access to it because they've contacted you too early before they got that package. Now, the people only find this out when they get taken to court and they think they don't have it, and then they show up with it. Now, if you can get them early on in the process before they get that package, you know, with all the actual assignments of debt, etc., it's a different conversation. But, I mean, if you had difficulty removing it from the credit report, going to the FTC even going sometimes to the Consumer Financial Protection Bureau, I've seen that have some success with people, just because effectively they, you know, post 2011, when everything went crazy after the mortgage foreclosure crazy stuff, they stepped up and they were actually a pretty good entity at helping people communicate with banks, because the banks went out of their way not to communicate with people, so it kind of forced their hand. So they were good. So you'd see them sometimes present themselves in a way that could be very helpful. I personally have not seen the FTC be that way, so I can't speak in that regard. I wouldn't know in that regard, but I would say I don't know how, if you were disputing endlessly, asking for copies of the debt, you weren't getting it. I got news. There's other ways you can dispute debts, and there's ways that you can just literally take off, like literally back out of the ownership and validity of the debt itself. I mean, there's ways to get accounts removed without even having to dabble in ownership of the debt or culpability or accountability relating to the actual purchasing on the debts. So, my personal opinion, doing this for 10 years and almost 10,400 clients, I would say you'd probably be better served going that way. If you go the FTC route, I just can't give you any proper advice, because I didn't even know that was an outlet. I mean, I know on the fraud affidavits they include the FTC on there, and it's stuff like that. But I mean, there's normally that's normally for an isolated situation. I didn't know they worked in a broad capacity. So if they do, I can't give you any specific advice on it, though.
Okay. And he also asked, which, you know, you may have answered this before, but for the sake of just asking the question, he says, also, does the same formula apply with FICO 10 being implemented now to reach the 800 score? ? No more than 30% of debt accounts good income, low to no DTI.
So, again, the other, I'm gonna go with the FICO 10 now. I feel like we get this question once a podcast, so just go over it again. So, Fair Isaac, which owns FICO, okay, is a publicly traded company. They have been coming out with FICO scores since FICO 1.
Correct.
Right.
On a yearly basis, right? Because it's a product.
Every year, because that's how they make money, right? That's how they make money. It's like the iPhone; they come out with a new model every year.
And there's the same shit.
What's that?
And there's the same shit.
And well, you mean the Apple? Yeah, it is. But as far as FICO is concerned, they come out with a new one every year. Right now, even though FICO 10's come out, we're only widely using FICO 8, and they haven't incorporated all the 7 prior to the 8 we're at right now. They don't adopt every single FICO that comes out. Those FICOs keep coming out. That doesn't mean they're immediately adopted. And honestly, normally, when the FICOs are adopted, which they don't, you can go back in history and see of the 1 through 8, all 8 of them have not been adopted widely. Very few of them actually have, a handful of them. So they don't just because they're coming out with new FICO, they're not like, oh, man, we're pumping that one through. No, it's a big undertaking. It's a huge undertaking for a bank to switch the FICO model that they're using, right? And they don't do it lightly. They don't do it callously. So I've heard this is another one I've had to, debunk for the last. It stops and starts. You can tell when it's flaring up online, but no, it's not something he needs to worry about. He should worry about aligning himself with FICO 8 and just be patient, because it's going to be a while before they probably slide out of FICO 8. They have come out with FICO 10. They came out with FICO 10 in January. Okay, right. We're in July. So if they were going to adopt it, I think it's fair to say in the last 6 months it would have already been implemented. That's more than enough time for them to adopt it if they were going to adopt it. But they're not. And they're not going to do it now. So they are going to do it. It'll probably be by the time they come out with FICO 12 or 13, because it's lagging in almost every single case. I haven't ever seen it be leading like that ever. So to answer the question, I would say, I wouldn't even waste a thought on that. It's not something that you're actually gonna realize anytime soon. Now, Correct. What was the second part of it about the DTI and everything like that? What was that?
Oh, he said no more than 30% of the debt accounts good income and low to no DTI.
Okay.
I got a question.
That
I
doesn't sound
got
like a
someone
question. It
called me
sounds like more of a
before.
statement. So maybe just didn't
Yeah,
need a
yeah, yeah.
response.
So someone called me last week and they asked me about FICO 10. I don't know if it was you, Antonio. But
No, I hear it honestly. I hear it 3 times a week.
Oh, okay. Well, it was probably somebody different. But
Yeah.
they asked me the same question and I said the same thing that you just finished saying. It's don't even worry about it. It's you gotta focus on removing the negative account first. All those negative items gotta be removed and then all those FICOs 8, 9,
Listen,
and
I'll
10.
give you guys another example. I don't mean to cut you off, but I don't want to
No, go
lose my
ahead.
thought. 2 years ago, was it FICO 9 maybe? Forget which FICO it was. There was a FICO that rolled out a couple years ago. Might have been quite a few years now, where they advertised it everywhere. And part of the formula was they said they were going to stop reporting medical collections on it. Do you remember that? Do you remember when that came out? That was part of one of the formulas that came out. It was all over the media. It was everywhere.
Yes, I remember.
Guess what? Nobody incorporated that one either. I used to get emails on that every single day. I thought they're not allowed to report it anymore. Then, I mean, again, obviously that fad slipped out and people came to the realization that it doesn't work like that. This is another example. Every single year they come out and they market it because it's a product, right? The same way Apple markets the iPhone every time it comes out. FICO does all kinds of press releases. They infest all these FICO boards and all these credit boards, and they do all this stuff to get people keyed on it to draw demand to it. It's not unusual. It's a big publicly traded company. Their stock actually trades at a reasonable value as well. So it's not like it's some penny stock. It's not. They make a lot of money over there, and it's a for-profit business, so it should be expected that the same kind of bullshit that goes on with other for-profit companies goes on there. So.
And it's the same thing, correct? It's the same thing. Curtis just says it's the same thing. Like principles of FICO change little, like payment history, utilization, credit mix.
Exactly, and they incorporate it very slowly. You understand what I mean? They don't make drastic changes overnight because you know how much that would impact people that just borrowed the day before. I mean, you're exposing yourself to a lawsuit. That stuff has to be feathered in. You understand what I mean?
Yeah.
So it's like it's not something that happens overnight. I mean, it happens when it does happen. He's absolutely right. It's very subtle adjustments, and it gets graded in over the course of time. They're not going to be on the cutting edge of a new formula and then expose 325 million people in the United States to it, not knowing if it's flawed. You understand what I mean?
Correct.
It's just not how it works. It's just not how we function as a society. So any concerns with that, I think, if I haven't painted a very clear picture, then I don't know how else clear I could be.
Correct. Antonio, we're not getting on you. Okay, this is more of a forum.
This is definitely. Listen, I've just heard the question so many times.
Everybody learns from everybody here. Okay, this is you saying that question. Everyone learns about it. You know, we got. I don't know how many people on here, probably 30 people, and everyone learns from one another. Okay, so you asked the question. That's why we say it. Tell you guys whatever question you have. Let us. Ask it. It's not a dumb question. Me, I'm an animal. I'll laugh, right? And then John, he hears it more. But we have good intentions for you. That's
no. But listen, the important thing, in all fairness, the important thing is the questions asked, because there's people that listen to this that aren't going to listen to something else, right? Another one that we've talked about it in depth. So the question is fine. I just get frustrated because I know where it comes from, and that's the frustrating thing. It goes back to what I was talking about earlier about inflation. Is that the flare-ups that occur on Facebook and a lot of these social media places with just misinformation, that all it ends up doing, it all ends up correlating back to some kind of money-making mechanism, right? Like they're trying to sell something, and this is why you got to be scared FICO 10's coming. You need to do this, and this, which normally benefits them monetarily, right? Correct. You gotta buy a house now because inflation's going to tick up, and you got to get out in front of it. Buy a house from me. You know what I mean? It's always culminated with some kind of an ulterior motive, which is grounded in misleading in an effort to capitalize on. And that's what frustrates me. The question doesn't frustrate me. It frustrates me when it starts to flare back up, and I get the questions because it's like, shit. It's I guess we just haven't gotten it out enough yet, or to the degree that it exists, So it's definitely not the question, though. I mean, look, we encourage the questions. That's why we have question and answers. So There
And
are no stupid questions.
and his whole deal with Antonio is that in regards to getting access to business credit, that's all I have. I appreciate you, brother. So eventually, he's trying to get. I believe in regards to getting access to business credit. Yeah, you need to have a clean credit file. Eventually, if you
Sure.
just got business credit, you're gonna have to personally guarantee. Is that correct, Jay?
Well, first of all, right now, most of the big, I mean, look, we talked about before, Chase came out in April and said they're not doing any business lending through the end of the year. American Express is cutting back exponentially if they're even lending right now on the business side. So a lot of the banks have cut back crazy. I still see the ads. Yeah, get to well. I actually had a client just ask me about this earlier.
Okay.
I said literally right before the podcast, he said, I was on Facebook and I saw this ad where some guy said, "Get you $200,000 for your business, and unsecured funding. Is this what we're doing?" And I'm like, No, that's not what we're doing. Right now, what we're doing is we're cleaning your credit. Then we'll start knocking out goals that are real. That's not real. You can't make a blanket statement on anybody that's looking at that ad, right, and say, "I'll get you 200 grand." That's nonsense. That's bullshit, right? It's specific to the individual, the business, right? The individual's credit, the depth of the credit, what the lending facilities are at that particular time. Because a lot of business lenders have cut back exponentially on their exposure. They've tweaked their algorithms even on the cards. Right, so you're not getting a lot of approvals. You're not getting the size of the approvals for what are very obvious reasons, right? Because there's a lot of risk out there right now. So they're not going to pepper the streets with money like the SBA. They're letting the SBA do that because the government's that backstop, right? They're not going to go out and pepper the streets right now when they don't know what's going to happen after the stimulus money starts to dry up. So no, it's just not. I said no because it's like. We'll see after we're done cleaning the credit, we'll see what's realistic at that time relative to your specific situation. That's the idea behind setting realistic goals and then achieving them once the credit's right? It's not misleading people and trying to, and give them a real legitimate financial advisor perspective rather than a real legitimate advertisement that one shoe fits all, because it doesn't. Not ever. Not in finance, at least.
That's why we're more of a positioning company. So we'll position you to do what you want to do with your credit. We don't just send out letters. I mean, if you want to do that, we have a $99 do-it-yourself credit repair system, and you could, do it yourself. Follow the steps, you get your results. But it's a process. Whether you do it with our system or whether we do it, it's going to be a process. The only difference is that we're going to be like hawks on top of your credit, see what's going on. If we need you to update your 3 bureaus, we're going to be on top of you to update your 3 bureaus because we don't like to waste time.
In all fairness, the $99 system is a small portion of our broader system. So it's not the same thing. At the same time, anybody that wants to do it themselves is certainly encouraged to. It's a good system to use. It's also a way that you can get results and pay $99 for it, right? And get endless support for that product and still get very good results. We get positive feedback every day on the system, so it's definitely a good way to do it. But like you said, what sets us aside outside of just the full financial perspective we provide to clients and the knowledge that we position them with is being able to get them to their goals as well, right? It's not just positioning them, but actually having to walk them through it. As far as we had another client, one of the clients that we've had, he just got approved for a mortgage on Saturday.
Who is this?
Two other mortgage companies, right? Two other mortgage companies couldn't approve. We got him approved Saturday with our lender. It just doesn't. I don't understand when that happens. I don't know how that happens, but it happened on Saturday. So obviously, mortgages are a big deal for people, and people are buying. People are trying to buy, which is great.
Yeah.
We also position on the business side. We position on the personal side, funding, auto loans, etc. And we don't typically charge for that stuff. So this is included in the service now. So this is just an extension of us trying to get you to your goals and sincerity and the transparency surrounding it. So. It's not something we're charging you additional and to set you up with an auto lender and get you approved at 2.5% or get you set up with a mortgage at a prime rate or help you start raising money on the funding side, etc. So it's just a part of our broader process.
Correct. So we were talking about the virus, the numbers and all that stuff. Then Curtis Davis says the internet has democratized information. Some people are taking advantage.
Oh my gosh! Yeah, every day, I feel like every day it gets worse.
Yeah,
it just gets worse, and I feel like people are getting turned. like here's why it's getting worse is because people can't watch TV anymore because it talks about the virus, right? Everywhere you turn, it's talking about the virus. There's no sports that are on. You can't watch sports. There's no good TV shows, right? You can have every cable channel.
How many Netflix series are you gonna watch, Jay?
What's that?
How many Netflix series are you gonna watch?
I've exhausted them all. I've watched every documentary I think that Netflix has. I'm gonna start doubling them up at this point, and it's ridiculous. And so what do people do? They go on Facebook, right? And I think Facebook is worse than television, right? As far as it just takes you to a deeper level of mental ambiguity because they add all kinds of conspiracy theories in there. And, I
watch The Floor Is Lava. Have you seen that show? It's it's like it's like what is it like? It's like the Beastmaster, but it's like funny where you fall inside the water. It's hilarious. But that's it. I'm done with it. It's like, what's next? Like, I might as well come and edit a video because sometimes it's all work.
No, because you can't. But this is why you've seen it get worse on Facebook now, right?
Yeah.
Because and Instagram and stuff because people can't watch TV anymore. It's all they talk about all day, every channel. Unless it's like the finance, CNBC doesn't really talk about it a whole lot, but it's incorporated into the market, so you get your dose of it. So it's like everything else, it's all they talk about. And so it's like I understand why people migrate over there.
Yeah.
But it's worse over there. It's just we're just in a really, really, really unusual state as a society right now. So
I have John Montano who we were talking about like money during coronavirus and all that stuff, and he said, I have a friend in Colombia. He went to the ATM and there was no money. Also, other people, the same in California. We're running out of change. Is Monday going to be running out? I mean, a lot of people talk.
Yeah, there was an issue with the change thing that actually happened 2 months ago, and there was a problem with the Fed getting change to the banks, which is insane to me. It doesn't make any sense. I mean, it was such a problem that he had to address it at one of his meetings that he did. Jay Powell, he had to address the fact that banks weren't getting the necessary change that they were requesting in order to operate, which is crazy. I mean, this is what I'm saying. Like, it goes back to what I was talking about earlier. Like, how you just have these things that are just so unusual, right?
Well, there is talk about people saying the digital dollar. I mean, we have debit card now, so we don't really need money.
It's irrelevant, though. It's a balancing, though, right? Mm-hmm. Like, there's a natural balance. If you ever see a bank at the end of the night, if you see a teller, if you know how a bank works, like an actual bank location, they have to zero out their drawer, right?
Yes.
So all the money that they took in went back out, or it zeroes out, right?
Correct. That
goes on with banks as well, and the Fed, because there's a constant borrowing back and forth. How on earth could you be light on change? Where did it go? Seriously, where the fuck did it go? I mean, did somebody eat it? I don't understand how change disappears. It doesn't make any sense to me that not only does it disappear, but the supply of it has just disappeared. To the point where they can't, they're having trouble dispersing it properly. It's puzzling, man. It's all.
What I think happens.
Understand how this stuff works, like how like a lot of this stuff works from point A to point Z. It gets you I have a very firm grasp on it. It gets very, 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 very confusing when you see some of these things happen because it just doesn't make any sense. Just like the overnight repo being short $81 billion doesn't make any sense. It should never happen. You should never be short change.
Oof.
Like you're talking about like you said, we're in a society where you don't even use change. It's crazy, man. It's crazy. It's nonsense. As far as the ATM not having money, though, most ATMs are independently owned.
Yes,
so that's a matter of the individual, not putting cash in it.
Correct.
Unless it's a bank-sponsored ATM, at which time it's the bank saying, I'm not putting any money in there.
That's very true. And they each have different fee structures on how much they charge you. Don't you ever go to a go-go bar trying to get money. They're going to jack you for $10 just to take money out. Okay?
Yeah, that's the cost of doing business.
But Jay, maybe with the money not being in the ATM, maybe the ATM bleached the money and so that it could go and get garden.
Maybe, but maybe honestly, in all fairness, he said Columbia, so I don't know about Columbia, but I mean, I know here, at least in Philly, I know for a fact because the one day I think I talked about it, I had to walk all over the city just to get to an ATM that had money in it and was working. So I mean, I know some of the areas and cities got hit with riots. They were emptying out their ATMs because they were getting hit. They were blowing them up. They were doing all kinds of things to get the money out of them. So they were emptying them out at a certain point in time in this process in an effort to mitigate risk. The independent owners, I think, just weren't refilling them, for obvious reasons because, you lose that money. There's no insurance on that.
Oh, yeah, right? That's true. Well, where John is from in Philadelphia, they were taking ATMs, and can you believe it? Well, they were
blowing them up.
They were blowing them up. That one guy killed themselves because they were blowing them up. He killed himself.
Wait, what do you mean he killed himself? I didn't even, when I left.
Oh, you didn't hear that? Yeah, there was a guy that he killed himself.
Yeah, he was teaching everybody how to blow up the ATMs. Is that the one you're talking about?
Yes.
Yeah, when I left Philly, he got caught. So you're saying something happened after that?
Well, I heard that someone got whatchamacallit. They blew themselves up. Like,
oh, wow.
It's crazy.
I don't know. Yeah, I mean, well, that's obviously you're talking about.
So Freddie, who's our customer, his mom started, and I think he started, right? Freddie Anguiano.
Yeah, I know Freddie, of course.
Okay, cool, Freddie. So, he's like, real estate is humming along, still like nothing happening, and we have second surge ongoing here in California. Cali shut down.
Right.
Yeah.
Yeah, but listen, Freddie is sold, man. So Freddie, I told you this before in another podcast. Said the same thing. Keep buying, buddy. You make your own decision, and I fully support whatever decision anybody makes. People don't have to listen to me. There's absolutely no requirement to listen to me. I try to give information for people to make the right decision. And just because it doesn't happen right now, I mean, there's a reason why it says patience is a virtue, right? Patience is a virtue. The guy that gets out in the front, the guy that goes and buys the first flat screen for $15,000 and a year later they're selling it for $2,000 is not the guy that gets the victory lap, right? So, correct. I mean, I'm just saying that you're more than welcome to go buy. I don't know about California prices, surging like you said they are. I think they were down year over year, and I know they're down since January. But
correct.
He's saying. What's that?
He's saying right here, prices of new homes are rising since the China virus started in March.
The price, maybe in that development he's looking to buy in, but
correct. That's true.
In the country, it's not. That's absolutely inaccurate. But I mean, again, look, like I said, and preface, I want to be clear about this. We try to educate so everybody can make the right decision based on the variables that they should be asking given the situation, or at least we allow an opportunity to give an alternative perspective or point of view on how you should be looking at how these things could possibly turn out, right? Mm-hmm. I hope that the economy just continues like Freddie to just take off like a rocket ship, right? And, the market will be up 30% next year, and the real estate market will be up 80%, and it just keeps storming higher, right, with absolutely no justification or economic understanding of it. But it'll just keep going up more and more and more and more. But the reality is that's not how the real world works, and that's not how economies work, and that's not how economics work. So I think if you want to buy, I certainly encourage it. I just, I want to give everybody the right amount of information so they can ask the right questions and see if it works within their buying pattern, right?
Correct. What Antonio asked, what do you think about properties? What do you think having properties when the tenants run?
The tenants are run?
Yeah, I'm thinking he's saying, what do you think about having properties when the tenants, when they leave, I guess. And then he says funds are through the government. Well, yeah, that's true. I don't know. He may be talking about.
He might be talking about Section 8. I mean,
yeah, Section 8. Section 8 never late. That's our.
They don't cover 100. Section 8 doesn't cover 100% of it. But to answer, if he's talking about Section 8, I mean, look, real estate's real estate. I mean, everybody. The thing that I love the most about real estate, obviously, is because I've been buying since I was a kid. So, I mean, is not only the equity side of it, but there's a tremendous amount of tax advantages that come along with it. I mean, enormous amount of tax advantages that come along with it, which we've talked about in previous podcasts, so feel free to watch it. But, I mean, obviously there's long-term capital gains. You avoid the short-term capital gains if you're not flipping, even though I flip as well, but I also like to hold. And at the same time, I mean, it becomes a leanable asset, meaning like you can leverage it if you need to as it continues to grow and appreciate. You don't have to sell it. You can tap into and buy more and more and more. Obviously, if everything goes as planned, right? But you're also making a bet on the long term viability of the economy, because real estate, in a lot of cases, if you're buying long term, it's a long term play. But during that whole time, you get a lot of tax advantages, which I think is spectacular. When it comes to Section 8, a lot of times Section 8 properties are in areas that haven't quite turned over. They're in tough areas where there's not a big equity play, but you end up, typically speaking, in most Section 8 areas, you end up making pretty good cash flow. So you're not going to get the equity component, but you're going to get the cash flow on the rental component, right? As far as how I feel about tenants that run, I got to be honest, in all the years I've been doing this, I've been buying and selling real estate for, what year are we in, 15 years. I haven't had. I think I've had that happen maybe 2 times, and neither one of them left the house in real terrible shape. So it was kind of an easy transition to put somebody back in. So I can't really speak on that in much depth. All I can say is that, I mean, if you do your job as a landlord, I think in a lot of cases there's a level of respect there, like there is in other walks of life.
Yes.
And normally that doesn't happen, in my opinion, or in my experience, because I've managed properties. I mean, at one point when I was predominantly in Philly, I mean, I had a management company. I was managing I used to build houses for hedge funds too. I had a particular hedge fund in New York I built a ton of houses for in Philadelphia, and I managed a lot of projects too, the properties as well. And I mean, it's like, it's the same walk of life, man. You treat people with respect, get respect. I mean,
even in the ghetto areas, John, people want to live in a clean environment. Come on, man.
It's just respect, man. It's just respect, period. That is a universal language that works across all boundaries.
Correct.
Right? You don't have to see eye to eye, but if you treat the human being with respect, right? I mean, a lot of times you get that respect.
And talking about respect, yo, just, we help out a whole bunch of people. But, we come across some people who, who want to get on the phone with us and they start cursing. They're not happy with their situation, with their credit. And, we don't take that. I mean, you got to have respect for us. We're trying to help you out, we're trying to help out the masses. With doing this online, me being on YouTube for so many years, it's all about just, trying to help out, educate as many people as possible. But we don't know who's in the other side. We don't know if that person's going through a hard time financially or whatever. But, I treat everyone with respect every time someone calls me, wants a quote or whatever. But sometimes we don't know who's on the other line or who's on the other side.
Listen, here's the reality. You like telling these stories about whenever we have like one problem client. I'd say out of on a 100% scale of clients, I would say less than 1% of them are problems.
I'm trying to avoid that 1%.
I would say that the people that have become problems, exactly what you said, where they got other stuff going on, and it just happens to present itself in this way. And there's issues that it's a part of business. It doesn't matter if you're selling lawnmowers, you're doing credit, you're a banker, you're a fund manager. It's the same idea. I think over the course of time, I'm very grateful for this relative to.
We've been getting so much better
5-6 years ago to where the level of the client that we get now, as far as their understanding and their overall approach and just everything, it's totally different. I'm incredibly grateful. But like anything in life, man, it's a lot of work. Not everybody's going to see eye to eye, but I think we've done a good job of over the course of time of getting of weeding out the people that necessarily don't align with our process or our approach, and retaining the ones that are in line with our approach. And I think that obviously makes the process much more fun, and obviously makes the process.
It's a lot of fun. It's a lot of fun.
Yeah, it really does.
I wouldn't be in this business if I didn't have fun helping people. Like, it's so much fun to be online, to have a whole bunch of y'all watching us, listening to us, getting educated. You become a customer. You thought that, you weren't able to get into a certain goal and financial goal. And the next thing you know, things start happening for your life. You start getting a credit card. You start getting a vehicle. The next thing you know, you're in a house. A year ago, you didn't even think about that. But now you're there. For us, is amazing because we were able to help you out. You know what I'm saying?
But it's not only that, but it's you're also coming through with what you promised. And in this particular business is like a brick of gold, right?
Correct.
Because there's a lot of smoke that exists, and the one thing we like, other than the 10 years, however many clients,
yes,
all the goals and everything we've hit for clients, that's the one thing I think differentiates us from a lot of other, just on a very binary perspective, is just the ability to come through for clients when a lot of, not to crap on other companies, because I know we're not the only ones. Correct. But when a number of other ones weren't able to for them. So I think it kind of reinstills some trust in the process. Just, getting them to the goals obviously is an enormous what's the word I'm looking for? Gratification.
Yeah. Correct. It turns me on when I come through for you. Okay.
So probably taking it a little too far, but that's, it's a couple.
So we got Siobhan Andrews who asks, I understand I'll have to PG when applying for business credit. Should I add high years authorized users and delete inquiries off my personal credit to get higher limits on business credit?
The AUs may help to give you some age. I don't know how the rest of the report looks. It's tough giving you an assessment without looking at the actual report. But if you're lacking in age, and obviously they can give you some age.
Correct.
Along with that, it really depends on where the inquiries sit. If you're under a sustainable amount, you don't need to have zero inquiries in order for inquiries to not play into it. You just can't have an excessive amount of inquiries. It's understood you're going to be applying for credit, right? It's the only way you get credit is by applying for credit. The only way you grow your report is by borrowing and paying back, right? So the understanding that you can't have any inquiries on there or else it's going to torch your score is a misunderstanding. And I'm not saying that she's suggesting that. We would need to see the report to really see how thick the report is, to see if you even need AUs.
Correct.
Or what the rest of the report is comprised of, and just how many inquiries there are. I'll tell you this off the top of my head. If you don't exceed like 6, 7, 8 on each bureau, there's no sense in touching them. If you're south of 10, you're fine. There's no real need to go in and knock them out, because you're not getting looked at in that capacity. You're not running into problems. I think everything else the same. I think the bigger problem you're going to run into right now, just generally speaking, is just how banks are lending right now, and just the details around it. Obviously, they're still lending money, but when you, especially on the personal side, but on the business side, you're running into a lot of contraction for reasons I already explained. So just be aware of that. I'm not saying they're not lending money. There's just a lot of banks that are contracting right now just because of the level of uncertainty. And a lot of the people that come through Facebook and that come through to Gizzy asking questions about business credit are people that don't really have companies. They build a company, right? They have, it's like a shell corp, and they're trying to fund it, and they're, it's a manufacturing of a business, and they're the ones that are the companies that have legitimate financials and that have legitimate, accounts and et cetera, are probably the ones that are still not having that time borrowing on the unsecured side, right? But the ones that are coming in with a manufactured file that's kind of getting made out of scratch, hasn't really generated any real revenue noticeable, they're going to be the ones that have the hardest time for obvious reasons, right? Because it's going to be more of a discerning environment on the business side.
Okay. Okay, so we have our current customer right now. His name is Armando. What's up, Armando? He asks, hi, Gizzy. I am in the process of fixing my credit with you guys. We went to the first round of disputes, and it looks like all the companies responded to the dispute. Is that common? And then Glenn Byage said, yes, it's very common. Go ahead.
Yeah, I don't know which one. We got a couple Armandos. So.
Oh, Armando Gomez. Games.
So we're not done. We're not even done his first round yet.
We're not even done with your first round. We're not even done with the first 30
None of the disputes have come back yet.
Oh, well, he's gotten letters, I guess. He's saying
maybe he's getting letters from the creditor.
Correct.
But he's not getting anything from the bureaus. Those disputes. We just started like 10 days ago.
And it is common for you to get letters from the creditors.
Yeah, and you can disregard them.
Oh, yeah, disregard them.
You can disregard them. They're not,
But get in the habit.
Letters, we ask you to send them over just because there's stuff in there we can use. But as far as using it as a point of reference, the creditor letters are not necessary to use.
Okay. All right, cool. So Andrew Johnson, Minnesota truck driver. What's up, Andrew? Hope all is well. He says, hey, Gizzy and John, when you've went through the first couple of rounds and then you ask for the method of verification for disputes and also the other round of debt validation, and they send back a copy of an old file that doesn't have a signature or any ownership, what should the next step be?
Well, I mean, number one, they don't need a wedding signature. That stopped like 5 years ago when everything got done electronically. So weddings, if that's still percolating around Facebook, that stopped like 5 years ago, and that's not necessary since most people's applications are done online, right?
Yes.
Very few applications of credit now require like a signature. It's typically a mortgage and an auto loan. All other loans you can do electronically. Even personal loans nowadays they let you do through DocuSign. So I would use that as a harbinger of a as far as if he's asking when he gets through the validation, because a lot of the purpose of a validation, right? When you get a collection, a new collection, any kind of collection, and it's a servicing company that's taking it or a purchaser, that's the right thing. Like, you'll get a letter, they have to send you a notice of collection, at which time what happens is you have 30 days to dispute the validity. Most people just ignore it and throw it out. But the thing is, that's when you should be, that's what the validation is primed for at that point. Because if you go back to what I was saying earlier about how debt buyers buy and sell debts, is that they literally send the Excel spreadsheet with a zip drive for all the accounts so they can start calling these people since they paid for it, right?
Correct.
But they don't get the actual file on those debts for typically, it depends on the size and the tranche that was bought, but it can take a good month and a half, 2 months for all that to come over, right?
Correct.
So if you send that validation, the validation is proper in that period of time, they're not going to have what they need. They're going to have to send it back or they're going to have to shelve it. So that's why that's a really opportune time to be sending out validations. But in regards to the situation, the other thing validations can do is it can reset what the bureaus have on file for that particular account, which can also help jostle the account loose if you're disputing it the proper way. So assuming he was disputing in a certain way prior to that, my suggestion would be to go back to that and mix it up after the validation, because more than likely it did exactly what I just said. And if you go back in and you do it afterward, you're gonna have some you should have some clear sailing.
Okay, so we got Curtis Davis, who invests in the stock market, and he says NASDAQ back up this week, he says. So Curtis, John, have you heard of Twilio stock?
Yeah, yes. For sure. Yeah, it's been running for a while. Twilio, it's a little high for me. Right now the tech stocks are just, in my opinion, they're just too high. They're just insanely priced. Amazon went up again today, some insane amount, which was, it's priced into like 2023 earnings unless there's some huge growth thing that we're not aware of. So it's priced so far right now that it's really hard to rationalize a lot of these tech stocks. But you know what? Given the fact that I do think we're going to run into the election at least, there may be more upside to go. I know Microsoft reports I think tomorrow or Wednesday, so it's inevitable that their numbers are probably going to be good, which is going to help bolster the NASDAQ and the Qs even more. And as long as Amazon keeps running, it's the same deal. But as far as Twilio, that thing has been running. So I try not to chase. For me, that would, getting into that now or even any time in the last 3 weeks would be a form of chasing, and I just refuse to chase. It is a good company, though.
Okay. He also says, how come people do not have real expectations on Facebook business credit? There's levels of business.
Yeah. Well, does he mean there's levels of business as far as in real life, or levels of business as far as Facebook on being able to get money. You know what I mean?
That on being able to get money. There's levels to of businesses. I guess.
Well, I'm not sure I understand the
How
question.
come people do not have real expectations on Facebook? Business credit.
Yeah. Okay,
There's
you say it in
levels
a
of
different tone. It
business.
sounds, they absolutely, no, for sure. And that's the problem, right? I mean, it goes for anything. It doesn't just go for business funding. I mean, just about anything, the expectations are jaded, right? In the wrong direction. You know, listen, my whole thing in general about anything in life life is about setting expectations, right? It really is. It's what it's all about is setting the other person's expectation. And if you're able to come close, you're beloved, right? But if you're somebody that consistently overpromises and underdelivers, which Facebook is notorious for in any walk of Facebook,
yes,
you know, you get just venom, which everybody fires at it because it's exactly what it is. I mean, it's eventually going to get regulated, but it'll get regulated too late, right? I know. More recently, they were trying to pass legislation where anybody that signs up for Facebook has to use their real name, and they go through a verification process. I think that's the latest thing on now, so that people can't hide behind profiles and stuff.
Yes. To avert fake news. There you go.
To avert fake news, but also make people stand behind what they're saying, right? So there's no confusion, because a lot of people will just say stuff, right, whether they believe it or not, and they'll just percolate it because they're bored. I mean, I know that's a small percentage of, because most people are just so profoundly influenced by their perspectives these days, right, wrong, or indifferent, but they still won't do it in their own name, right?
Yes.
So, I think that as it comes to just expectations when it comes to sites like Facebook and Craigslist, they're just trying to get bodies in the door, man. They don't care about executing in a lot of cases. To tell somebody that there's it's just some of the stuff I've heard over the years is just disturbing about how, you know, they draw people in and say, anybody can get $200,000 in business funding, we'll build a business for you. Correct. We'll do this, that, the other thing, and they charge them all, and it's nothing. It's curtains, right? I mean, I don't even know if any of this stuff even happens. Problem is, they sell them on a story, and I just don't. It's unfortunate, and I just don't know why there's not any element of regulation or expectation. It's part of the reason why we like to do this stuff is just to educate, you know. But I just don't think, you know, our stuff gets out to enough people. Shame. I mean, it gets out to our clients, and I know for a fact that the clients that go through our process and leave on the other end, they're exponentially smarter when it comes to financial things than when they came to us, right?
Yes.
And understanding what's real, understanding what's smoke, understanding, you know, how these ratios work for a mortgage, how the ratios work on credit cards, auto loans, etc. One of our clients, Lonnie, the other day he came to us not that long. He came back to us, actually. He got approved for like $45,000. His interest rate was like 4%, I think.
On what,
Jay?
He
was so happy. Yeah, he was so happy.
On what? What he got approved for?
What's that?
What he got approved for?
What car? Well, he got his approval.
Oh, he got his approval, $45,000 car. Okay.
$45,000 at 4%. I mean, you're talking about. I mean, for him that was borrowing. I think he was borrowing. Let's just say a lot more before. I don't want to put his stuff out there on Front Street in case, you know, just in case he doesn't want to talk about it. But I'm happy for him. He's at 4 now, and he was ecstatic about it. And he should be. I mean, it's a great thing, and he's learned a lot in this process. So the clients that come to us, we love the fact when they're actually when they're involved too, you know. I mean, it's great. It's a beautiful thing. And then when they hit the goals and they're excited about it, then it's hard work paid off.
Okay, Freddie says, "Hey John, if you plan to stay in the house for a long time, put 20% down. It's always a good time to buy a house?" ?
No, because you're 20%. Yeah, if you're treating your 20% like you just want to set it on fire, then yeah, sure, buy whatever number you want to buy. But I mean, look at it like this. Let's just use round numbers, okay? Let's say you buy a house in Bergen County for $1 million, and it was only worth, you know, the market that they were asking $950, and it got bid up about 6% over market. Okay, correct. You put 20% down, so you financed $800,000 of it, right? Let's just say that again, keep in mind you bought it for $1 million. Put down 20%, which is $200,000. You financed $800,000 with closing costs. About over there in Bergen County, it's probably 6%, so that's $60,000. So you're into it for $860,000. Okay, it's worth $950 because you overpaid for it. Okay, so now your delta is about $90,000. That market only needs, literally at that particular point in time, if you turned around that day and sold it, you have to pay 8 points again to sell it. 6 to the realtors and then 2 in transfer tax. So at 950, you literally have just paid out 8% on 950, which drops it another $75,000, which takes you down to 875. You would break even. Your 20% would be gone, and that would be literally if you bought it and then sold it for the same amount that you bought it for. Wow. So just do the math there, because you overpay. It's not. There's not enough knowledge, and I'm sorry to say this, it's a fact. A very small percentage of overall real estate agents are good at what they do. Okay, it's just a sad truth. It's like any line of work. But the reality is, there should be a lot more emphasis put on the numerical portion of it, and just how important it is to buy any house at the right number. You know, throwing caution to the wind and shutting your eyes and buying anything when it comes to property is insane. Yeah. I mean, it really is. And just treating it like, yeah, you put 20% back. Yeah, man, if you want to mail 20%, you know, you want to put it out in the boat, set it on fire, and never see it again, then just blindly buy and put 20% down. But, I mean, you always got a budget for a worst-case scenario. Worst-case scenario, let's say you buy it in a year, you got to sell the house. You got to move. Your job relocates, right? And in that example I just gave, let's just say it's not worth $950. Now, keep in mind, I didn't even factor in that example if the market pulls back 5 or 6%. Because if it did, in that example, not only would you lose your $200,000, but you would have also lost more money that wouldn't have covered the mortgage. Because let's just use that same example I gave. You're into it for $860. You bought it for $950. Let's say the market moves 6%, right? It's now worth $900,000. You're into it for $860. Okay, with closing costs, $860. Now it's worth $900,000. When you sell it, you're 8% off of it. You're into it for $820. You've just lost $40,000 on top of the $200 you put down, and that's only if the market moves 6%. So just think about I mean, it's very important for people to actually put pen to paper and actually make sense out of this stuff, because you can get hurt. You know, it can be hurt on a primary residence, which is exactly why I keep getting so angry when I hear people overpay for these houses. It's insanity.
Oh, the realtors, they love saying, I sold this house.
Yeah, of course 70%, they do. Of course they do.
70,000 overpriced.
Because that looks to whoever's considering selling, right?
Correct.
This is the guy you want selling for you, right?
Oh, yeah.
And if you're the guy buying, what you should be saying is, I don't want this motherfucker helping me with anything. Right? Yeah. That's what you should be saying, but you're not. So that's why you always see, like, people are like, yeah, I'm a seller's agent, I'm a buyer's agent, because there's two fundamentally different approaches, right? So I hope I answered Freddie's question in clarity, because you can really get hurt thinking along those lines. I mean, seriously. I mean, the example I gave was just if you turned around, if you overpaid a little bit, you ran the price up, and you put 20% down and you turned around and sold it for what the true value of it was versus what you marked it up at. And I did that example on purpose because you got people that are overpaying right now, which is insanity to me. It's so dangerous, man, and reckless.
Yes. Okay. Okay. So we have let me see. Oh, Armando Gomez, who asks, what about the grants that the government is offering? Do you need good credit to be approved? What grants are you talking about? I think you had that question before. Grants for like people who work at the hospitals or something like that. Remember I asked you that question, Jay? Or I don't know if I did.
Say it again.
The grants. What about the grants that the government is offering? Do you need good credit to be approved? Grants.
But is he talking about? He may just be talking about
EIDL.
Yeah, that's my guess. The PPP and the EIDL, and if that's what he's asking for the SBA programs for the business owners, you need at least a 575. So that's and they pull experience, so you need at least that much in order to be able to qualify from a personal credit perspective.
And they pull experience. Okay, great. Then John Montano says, you are right about Facebook. It's crazy to hear kinds of stuff. To take that doctor talking about this cure, the virus. Oh my gosh. Correct.
Yeah, it's insane.
It'll drive you crazy.
It's just, I mean, honestly, I haven't ever been somebody who likes to read ever, unless it's like isolated, specified reading. You know, if I'm reading on this, or I'm reading on that topic or whatever, you know what I mean? Especially finance related stuff. I mean, I told my wife the other day, I'm like, I'm just going to start reading. I don't know what the fuck I'm going to read. I'm going to read something though. I'm I'm gonna read my hand if I have to. I can't watch this stuff anymore. I'm not on Facebook on purpose. So I just
Yeah, I'm the only access to social media that John has.
Yeah, but that's on purpose.
Yeah,
so
that's on purpose.
I mean, I purposely do that just because I haven't ever had any interest in it. I haven't ever seen it going back as a positive, even going way back. It wasn't ever something I viewed positive, and it's playing out exactly how I don't think anybody could have anticipated it got like this. But I mean, it's just gotten to the point where it's. I mean, I'm not even on it, and I'm hearing on a regular basis the craziness that goes on there, right? So
John, the best thing for you is not to be on it, and plus, you're more productive now that you're not.
No, I'm not. Listen, I'm not wavering after 10 years.
But don't worry about it. This is, I'm on Facebook and Instagram every day, so.
No. I have. Listen, there's this decision that was sealed 10 years ago. I got no interest. Trust me, I'm not. There's absolutely zero interest in doing it. I just. To answer his question, though, it is crazy, man. It's crazy, and I don't see it fixing. Let's put it that way. I think it's only going to heat up going into the election too. It's only going to get more intense.
Didn't you see Kanye West yesterday had his first rally? He's all over the news now. Oh, it was hilarious. Yes, Armando Gamez says yes, the PPP. Okay.
Yeah, so it's 575.
Okay. Okay. So. Then we have Ricardo Roper says, "Hey Gizzy, I co-signed on my brother's student loan 13 years ago, and these people are still coming after me, and a firm from out of the state slapped a judgment on me which I had removed from reports. Now they're a new law firm. What can I do to get rid of them so they won't garnish me or anything else?" Well, we had a podcast on that.
You can't do anything. That's the one thing we tell clients all the time. You can't get out from underneath school loans. They'll follow you around for 25 years. They'll cheat. They got that. If they got a judgment, they typically don't need judgments. By the way, they typically can garnish you anyway because you're effectively borrowing from the United States government. So, I mean, if he actually went to court and they got a judgment, I would be surprised by that. Typically speaking, they have the ability to go, and they normally send a letter out notifying clients that they're going to either take your tax return money garnish, or they're going to take all those measures if you don't start getting on terms with them. And if you don't, then that's exactly what they do. And we've had to get a lot of clients out of the garnishment. It's a process. It's not easy. And it's very painful for the client, because what they end up making you do is they end up making you, they take a big chunk of your money, and even in that, you have to make, in a quick scenario, they make you pay it for, I think the quickest we got was 4 months, and that was, you can make 2 payments in the first month, and that's 2 additional payments, by the way, over and above what they're taking out of your check, each check you get. And then the second month is another payment, the third month, and then the fourth month you make 5 payments. After that, then they'll release the garnishment, and then you go. But by that time, I mean, they've basically chokeholded you. So my suggestion to you would be, if you haven't been garnished yet and you are a wage employee where they have the ability to garnish you, I would call them and get on one of their income sensitive or one of their modification programs, because you're not going to get away from it. You're not going to get away with it. There's few things I can say with more clarity than the fact that if they've been chasing you around this long, they're not going to stop. So rather than, given the fact, I don't know what your income's like, I don't know anything about your situation, but I can tell you they make some of the most sweetheart deals you could possibly imagine in the school loan world now, in an effort just to get people producing. So, we have clients that are $10 they pay a month, so I'm sorry to hear he's co-signed for his brother, and that his brother doesn't seem to be the one having to have this conversation. But if it isn't, that's not the case. He should definitely call them and start getting on terms. I don't even know how much it is, but if it's a lot of money and he doesn't have the ability to settle it with them, which I'm sure they would probably do, then I would call them and start getting on terms. Otherwise, it's going to continue to follow you around, and not in a good way.
Correct. Student loan. I think we have a podcast on that. It's right over here.
We have one on the garnishment too. We talk specifically about.
Yes. You see right down here, it says how to remove student loan, right there.
And we talk about the garnishment. We talk about the whole garnishment scenario too, and a particular instance with one of our clients that was recently when when that came out that we had just helped. So it goes into a lot of depth.
Right here is the podcast. Right. Okay, so yeah, this is the podcast. A lot of people have seen the podcast, and if you want more information on it, I say, guys, look, we've been doing this for a long time already. I mean, not only have I been putting both, credit repair results videos, but all these Rona breakdown, all these credit has been John. John has been educating us since Christmas, the day after Christmas, December 26th, right, Jay?
What, since we did the first podcast?
Yeah, since we did the first podcast.
We did it with our client. Yeah, it was. I think it was the week of Christmas. Yeah.
Yeah. So you guys get a lot more education. All right. And then we have the law firm. Yeah, but Ricardo, make sure you check out. But John's right about them giving you sweetheart deals. Yeah, flat screen 15,000 in '08. Now $100. That's Curtis Davis. Okay, so then Brett Munden said, how long does it take to remove a Chapter 7 bankruptcy off your credit report?
I mean, is he asking how long it takes to age off, or how long does it take?
Just to no, he's talking about like if we go and do credit repair, how long does it take to remove it? I mean, we could remove it.
Yeah, but hold on. This is the problem, and this is where the expectation from what I was saying earlier comes into play, right? Is it
okay?
Like, the fact that there's people out there pushing service and saying that there's a specific amount of time that you can quote somebody walking in. If somebody says that to you, they're not being honest. There's just no way. I mean, I'm told this is somebody that's helped over 10,400 people in 10 years. I've done this successfully that amount of time, right? I mean, there's no way to literally walk into somebody's file and give them exact time. I mean, we have new clients. Anybody that's on this podcast is a client of ours. You know what we say? We always say there's just no way to give an exact amount of time. The way what we do is we base it off the large median of people that we've helped, and we base it off of an average, and that's the best we can do. So if you have helped 10,400 people, and the average turnaround time is anywhere from 2 to 4 disputes, that's a pretty good idea. You're going to fall somewhere in that range, right? But there are some people that take longer. There's some people that get done shorter. But a large majority fall right smack dab in the middle. And without looking at the file, I can't just spitball how long it's going to take to remove a Chapter 7, right? Because when we set expectations, they're expectations we intend on coming through on, because that's how we get referral business. That's how we get repeat business. That's how we can show results. We don't do it just to get you in the door with the idea that you're going to fizzle out as a client, and we're not really concerned about your livelihood as far as where you get to your goals. I mean, this is like a legitimate process we operate with.
And a legitimate we have a legitimate process and system set up. You watch a video, you contact me, I send you my info. The customer service that John gives is very direct and very, straight to the point. And people love that type of service. When you just be direct with them, send them, yes, it's gonna take this time, or you email us, we email you back ASAP. I mean, we take your success seriously, if anything.
Yeah.
Okay. So Ernest Dobson says, I'm pretty annoying. Nah, you're not that annoying, Ernest.
He's not annoying at all. Why would he think he's annoying? Unless he's about to ask a question and set up and being annoying, but he hasn't been annoying as a client.
You all right, Ernest. Glenn Byage, that's how I feel. He says, got cards, as in credit cards, and cars, vehicles, soon a home. He laughs. Good for you, Glenn Byage. Okay, then Freddie says, John and Gizzy, why is Capital One and other affiliates of them are so hard to remove? As you guys are working on my mom's file. Just heard lots of stories of Capital One resistance.
No, it's not. I mean, look, from a simple perspective, Capital One's only 95% of the business is obviously credit cards. So, yeah. I mean, if somebody's trying to sell you a story on Facebook, they're going to use that as justification, right? That they have the ability to focus more on the dispute side of it, which they don't. But that they did, which makes it more difficult. We don't. It's not a particular type of creditor. Gizzy, I can't imagine and you correct me if I'm wrong, but I don't remember over the last 10 years us ever being like, man, that's really hard to get off. It's specific to each individual file, right? And the particulars of that file. That's what we say all the time. It's not something that you can walk in and be like, yeah, it'll get done in the snap of a finger. Sometimes they do get done in the snap of a finger. I think we talked about this before. We've gotten files that only have a couple of accounts on. I mean, I've gotten them done in 3 hours before, literally 3 hours. I mean, it was the quickest I think it took before, which is insane, right? So, but that's not normal. That's not the normal turnaround time. That's not the average. The average that I provide is the average I provide, and that's what we go in with, whether you have one negative account or you have a slew of negative accounts, because that's an average based on a very large numerator that we're backing it in from. You know, we're not just shooting from the hip like, there's one account, so it's going to take 15 minutes, right? Because that's nonsense. That would be ridiculous to, and we're not in the business of over-promising.
Correct.
We're in the business of setting expectations. So, Freddie, I can't tell you that we had problems with Capital One. I can't tell you that we have specific problems with specific creditors. But I can tell you that, there's certain files, just with the dynamics of that particular file or any number of other variables, which I'm not getting into right now, because it's a wormhole, but that can impact, accounts taking a little bit longer than they typically should.
Okay. All right, Freddie. And Andrew Johnson says, thanks, guys, for the information when he asked about that. Curtis Davis says, I'm Twillo up 99%.
Yeah, it's way up, man. It's crazy up.
Then we have Eric Gigliotti, who is referring us a bunch of people. He says, it's best to use lines of credit and high credit cards, balance transfer checks to buy real estate and then do refi. Line of credit range 4 to 6% a year and balance transfer is 12 to 18 months interest free. What do you think about that, John? No.
Lines of credit for sure. We did a whole podcast on this, buying on credit cards and stuff. I mean,
that is true. It's right over here. The buying real estate.
Obviously, lines of credit for sure. The amortization is longer. The way they amortize the payment is different. The rates, depending on if secured or unsecured, is going to deviate, and obviously that deviation is going to play into the payment. But buying on credit cards and stuff, that's you have to have a clear entrance and exit strategy to be able to make that sustainable and it not completely torch you. Even when you're doing balance transfers, though, they're hitting you for 3.5% on your balance transfer. So you're transferring $50,000. That's 15. That's what. You're talking about, that's an extra $2,000 that you're paying that's coming out of the profit side if you're playing on the real estate.
Right there where it says how to do the numbers. How to do the numbers correctly. That real estate podcast. John.
I mean, we talked about it a couple of times. One of the earlier ones where we went through mortgages, we went into a lot of depth on it. We talked about it with the one with Carmelo. We got into it there.
Yes.
I mean, we've talked about it a number of times because it's another thing that floats around a lot. So.
But Eric keeps doing it. He says, I own a few properties, never applying for a mortgage using that system.
That sounds great. But I mean, I don't know the specifics behind the borrowing costs surrounding him. I don't know anything about it other than he said he's buying on lines of credit at 4%. In order to get a 4% line of credit, it has to be secured with collateral. There's no unsecured credit cards that are floating 4%. I mean, literally, a mortgage is 3%. So to think that an unsecured credit card is at 4% is insanity and not true. So, I mean, it would have to be a secured line to be able to do it. And if it was a secured line at 4% that he's borrowing on, then that makes a lot of sense because it would be run out and amortized over 30 years. Right, and that's a dream scenario. Rolling that kind of an amortization into a 0% balance transfer where you're paying 3.5% to transfer it over, I wouldn't really understand that. But if he's got a fluid system that works for him, by all means. It seems like money's slipping through the cracks though in that scenario, like a good amount. I mean, just on the 3%. I mean, if you're targeting 20% on a return on an investment deal, and you're giving 3.5% away to a balance transfer, you just lost on a $100,000 property. You lost $3,500. Or you just cut your return from 20 down to 16.5 just based on that balance transfer fee. So, I like I said, if it works for him, more power to him. I probably need to see all the specifics in order to really make sense out of it because I don't know how 4%. I'm thinking he's got it. If he says he's borrowing at 4% on the unsecured side, I mean, I don't know where that's coming from.
Okay. So Ricardo Cooper, Rupert said, sorry, Gizzy, it's a private student loan. So even private student loans, you can still do that. You can still set up a payment plan, right, Jay?
Well, it depends. If it's Sally Mae, yeah, look, in any instance, you can set up a payment plan. If it's a private student loan, it's a little different than the public one. So if it's Sally Mae, they're the most difficult in my experience. But at the same time, yeah, in any of them, that's all they want to do is get you on a payment plan. Okay, that's it. Okay. They know the chances of them being able to get you to pay it all at once are small if it's a larger amount. So they just want to get you performing. And if it's with a collection company now who's out shaking you down, the idea is that you make like a certain amount of payments with them, and then they send you back to the original student loan company after rehabilitation period, they call it.
Okay, we got Anibal Colon, who asks, off topic, what can be done to help with father-son credit mix-up again? Sorry, off topic. You know how you have, mixed files, like I'm a junior and we have the same name?
Yeah, we talked, no, I know. I think we talked about this Honorable before. So the way to do it is to just have a differentiator, right? So in his case, what we're going to do about it, once we're all said and done, we're going to add a middle initial, which we typically don't do. We're going to add a middle initial because it should deviate from his dad's at that point, I think. If it doesn't deviate, then we're going to have to put his whole middle name in there in an effort. And that middle, that full middle name, I don't think he's a junior. So I think it was just the first and last name that were the same. And if so, you just need to add a denominator to the name, which will help to provide individuality outside of his dad. Now, the alternative to that, there really shouldn't be an alternative to that, because honestly, there's like 4 or 5 bullet points that attach an account to the report. And when it comes, if a lot of them don't match, then if any of them don't match, it's going to impede the ability for the account to report. So when you have that kind of a specificity relating to the first and last name, and you add a middle initial, you add a middle name if we need to, that would allow the opportunity to give some differentiation.
Okay. All right, Anibal. Okay, then Freddie says, I hope for the average sweet spot 3 to 5 rounds. Thanks, John. And then Freddie also says, hey, John, who you got on tonight's game? Philadelphia Union versus Orlando City football game, which is soccer game.
I know what he's talking about. No, Freddie, I'm not. That's not my sport, man. I'm not. Number one, I go to bed early. Number two,
he's a workaholic. John is
number two. Soccer is not my sport, man.
So. Let me tell you something. John is a workaholic. All that guy does is work. I mean, he's a beast. Yeah, I mean, I'm from El Salvador and I live here in Jersey. They got the Red Bull Stadium like 20 minutes from me. I don't, sorry, I don't play soccer. Just because I'm from El Salvador, I should play soccer, but I don't even follow it. Anyways, Jay, Anibal says, thank you, fellas, appreciate it. And I think we're done with the question answer session. And anything else you want to end up today to the fake news?
Just like you said, we always wrap up. Just if you know anybody that this information can help assist with, or can you think that a lot of our podcasts could help educate them as well, whether they're a client or not. It's not a prerequisite. That's not the entire reason we put this stuff out. If you notice, we talk very little about the service. We talk a lot more about some of these broader topics in an effort to try and educate people. So you don't need to be a client to listen. You don't need to want to be a client to listen. If it can help and it can educate you, give you a better understanding and making the right financial decision for yourself, or going forward, preventing yourself from making a bad financial decision, obviously that's a large part of us doing these. And if you know anybody that can be assisted with them, please, obviously like it, and then, share it with them, please. We love the more exposure we can get with this stuff as far as the education we're trying to get out there. I think the more we can accomplish as far as that's concerned. And just with so much misinformation out there, I think the right information, most people can because I try to walk this stuff through, right, from A to Z. I don't just throw random ideas out there without kind of walking it back or explaining the frame of thought. Yes. So hopefully with that allows people to really kind of rationalize the things that are being said, whether you have a functional knowledge or a deep level of understanding or not. So
That's why we're on for 2 hours and 28 minutes right now, because we want to, go into it easy and really explain it, because, the level of education, for some people, this just goes right over their heads.
Yeah, well, that's why I try to go into a lot of depth with it, right? Because the more information you can take out, the more stuff you can extract from all these podcasts, and a lot of the broad topics we cover, and a lot of because a lot of them are pillars of finance, right? Yes. And understanding things, and when you put all the pieces together, the things that we talk about, you'll see the puzzle coming together. That puzzle being just a well-rounded understanding of how things work. So if you listen to all of them and you go through all of them, we're going to keep coming out with more that are going to provide a little more caveats that help to bring the broader picture together. But if you listen to them, then you'll realize that a lot of the stuff that you may not have understood before will maybe start to become a little clearer. Maybe you'll be able to start to pick up on a lot of the nonsense that's out there, rather than be on the receiving end of it. You know what I mean? That would be a beautiful thing if that's the case.
That's what's up, Jay. Glenn Byers says, thank you, John and Gizzy. And right now, just smash that like button, please. If you still haven't liked the video, smash the like button. I want to say thank you to John. John, thank you so much. I know you got a couple of emails you're going to get back to. Another 2 hour, 30-minute podcast of education. Thank you so much, Jay. And see you later.
All right, dude. Yeah.
All right, take care. Okay, mi gente, smash that like button. Tell your friends. We here for you. Anyways, thank you so much for logging on today. Hey, listen. What is inflation? I hope you learned something new. Or if you want to refresh some things, definitely, if you have some friends out there that you want them to kind of have an understanding, we do these podcasts every Monday, 6 to 8, sometimes 8:30, depends on how many questions we get. But definitely appreciate you guys logging on, and thank you for liking and sharing, and listen, subscribing to the YouTube videos as well. Definitely appreciate you. And with that said, who wants the GizzyCredit theme song? Let's do this. Choose. There we go. There we go. Desktop. Okay, mi gente. So, see you guys later. And bendiciones to all. And Gizzy, we need more midweek videos. I do credit repair results videos midweek. Okay? So just be on the lookout for them. They take time to make, because I do commentary on them. But it's videos. But we go live every Monday. Anyways, mi gente, thank you so much.
Hashtag GizzyCredit. Hashtag GizzyCredit. Hashtag GizzyCredit.
GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. Gizzy. GizzyCredit. Anything you want, then you can get it. Don't get scammed, cause then you'll regret it. You no longer gotta look pathetic. GizzyCredit. Don't get scammed.